guys, how are you all? My name is Afreen Azmat and I welcome you all in today's session. So this session is indeed very important for all of you guys. Why? Because in this session of PPP, I'm going to cover all modules, module A, B, C, D in this complete one video. So you will not only get the conceptual clarity, but a lot of questions also to practice yourself. This video is very important for all you bankers, for your preparation and for your clearing clearing your examination. Thank you so much, everyone. Just watch this video and enjoy. Thank you. And we are going to start module B. So module A is finished, right? So we are going to start module B. Okay, PPB Module B. This is principle of lending, different types of borrower and type of credit facilities. This is unit 22. Right, so let's start discussing this topic. First of all, the cardinal principle of lending, very important portion of this complete chapter. So the business of lending is not without any certain inherent risk. You all know that if you are lending as a banker, you will involve yourself with a lot of risk, okay, especially when the bank depends it largely on the borrowed fund. Now, what the principle of lending means? What the things you need to understand while giving any type of loan. So if you are giving any type of loan, you are lending, right? So you have to make sure about these six things. If you are making sure about these six things, these are the cardinal principle of lending, right? So first of all, if we talk about the first thing, that is safety. You want to ensure that the funds you are lending to the borrower should be safe. You should ensure that the fund, whatever the fund you are lending, it should be safe, right? Second, it should be liquid. Second is what? It should be liquid, means your fund shouldn't be locked up for a very long period of time. It is very easily convertible into cash. Third, of course, you have to see the profitability. Of course, you have to see what? You have to see the profitability of the related things, right? Fourth, you have to see the purpose. For what purpose you are giving loan? See, you are not giving loan just because the person is asking for you, right? This is not a way of lending. You are not just giving loan for the sake that the person is asking for you. You have to give loan because there is some specific purpose, and that specific purpose should align with the bank's policy, right? Diversification of the risk. Now lenders should diversify their loan portfolios to spread the risk. So banks actually do what? So they set margin for each and every sectors, okay. So for lending, for example, they said that okay, we have to lend in each sector this amount of money, okay. Why? Because see, if any one sector goes in recession and they are not profitable from these sector, the rest sector will give them the money, right? So to diversify their risk, to spread their risk, the lender should have to diversify their loan portfolios, right? Now, the securities, if we talk about the securities, yes, there are 7 C's to judge the securities of the credit. And what are these 7 C's? Character, capacity, capital, collateral, condition, cash flow, and credit worthiness. So these are the 7 C's, okay? 7 C's for judging the security. There is a diversification of risk, there should be a purpose, there should be a profitability, there should be liquidity, and there should be safety, right? Now there are different type of borrowers a bank is dealing with. So bank are dealing with a lot of borrower, if we are talking about. So what are these different type of individuals to which the bank is dealing? What are these different type of borrowers to which the bank is dealing? First, the minors. So those who are under 18, they cannot form a valid contract, right? So what agreement made with the minors, they are actually wired from the very first step, right? So if there is any assets that are pledged for minors loan, these are not recoverable except it is for necessity. So if there is a loan that is given especially for the necessities, for meeting necessities of the buyer or of the minor, then their personal estate is liable for the recovery of that loan, else it is not liable, okay. So Section 68 allows that a minor's property is liable for such type of loans. Clear? Now, unsound person. So if we talk about the unsound person. Unsound person, yes, individual who are not of sound mind can't enter into a valid contract. They cannot enter into a valid contract. Okay, next, disqualified person. If you are statutorily disqualified individual, you cannot enforce into any contract which is made under Section 11 of Indian Contract Act, right? Married women. Married women are allowed to independently obtain loan from the banks and their husbands are not responsible for their. If there is a Pardhanasheen woman, yes, despite of different obligations and strictness, a Pardhanasheen woman is all allowed to have a loan. Yes, but there are extra verification that is done in this case. If there is an illiterate person can use their thumb impression for having the loan, right? Reading and explaining document in front of the witness is very crucial, right? Next, if we talk about the different type of borrower, so these are the individual. Then we have a proprietorship firm. Now, if we talk about the proprietorship firm is the firm which is owned and handled by the single individual. So these are those firms which are handled and owned by the single individual. Then these are known as proprietorship firm. Sole proprietors have an unlimited liability. Means if there is any default on loan, their personal asset is also liable for the recovery of such. Right now, partnerships. Yes, partnerships are regulated under the Partnership Act of 1932. So there is a Partnership Act of 1932 under which the Partnership Act is regulated, right? Now, if we talk about the partnership registration is actually not mandatory. It is not obligatory, but yes, if you do, then it is very good, right? So verification is essential. It is not obligatory. Verification is essential, but it is not obligatory. So if we talk about the essential ingredients of the partnership firm, first of all, it is an association of individual. It is not a firms. It is an association of individual. It is not association of firms, right? Two existing partnership, they cannot merge into a one thing. They cannot merge. Okay, so if for example there is ABC limited partnership, there is XYZ partnership, these have three partners, these have four partners, right? Now if we talk about these two partnership, can these two partnership form another partnership? No, but yes, the member of any of these partnership can form a different partnership, that is allowed, but these two partnership can merge and form a new partnership. Okay, and the limit for the partners in a partnership firm, if it is a profit-based partnership, it is maximum 50 partners, right? Now, if we talk about the Hindu undivided family. Now, what is a Hindu undivided family? Okay, so Hindu undivided family is actually automatically formed when Hindu, Sikh, Jain, or Buddhist families come together. It includes all the person lineally descended from a common ancestor and their wives and unmarried daughters. Okay, but now this is the ruling of Delhi High Court that married daughters are also can also be the co-partners in the Hindu undivided family. Right now, the member family is known as the co-partner, whereas the eldest male child is also is known as the karta or the manager. If we talk about the liability of the co-partner, it is limited to the extent of share they have in that property, whereas the karta, the manager's liability is unlimited, right? So if the account is open in the name of Hindu undivided family, all the adult member has to sign that account even though the karta can only operate the account, right? So co-partners liable, it is only to the extent of share they have in the family property and there is no personal liability. Clear? Next, now there is a limited liability partnership. Everyone, whoever is watching this session, guys, it's a request that please like and share the video to the maximum you can. If not, you are not liking and share the video, then we educators are generally not motivated. Everyone, this is the new channel which is started for all of you. Okay, and this is especially for those students who are in English medium. So kindly just please support and like and share the video to the maximum you can. Right, everyone? Okay, done. So next, there is a limited liability partnership. Now, what is a limited liability partnership? A limited liability partnership is formed under the Limited Liability Partner Act 2008, which have a perpetual succession. Perpetual succession means the changes in the member does not affect the existence of a limited liability partnership. The changes in any of the partners, the changes in any of these partners cannot affect the perpetual succession of a limited liability partnership. Now, a limited liability partnership should have at least two partners, and they have at least two designated partners, and one should be a resident of India. Okay. Now, who cannot be a individual partner in a partnership, limited liability partnership, if he or she has unsound mind, discharge, insolvent, pending insolvency, etc. Right now, under this limited liability partnership, there's a concept of small limited liability partnership. Now, what are the small limited liability partnership? A small limited liability partnership are those partnership in which the contribution of each partner doesn't exceed 25 lakh overall. Means if you have how many partners, no matter, but the contribution of the partners doesn't exceed 25 lakh. And if we talk about the turnover for the immediate preceding financial year does not exceed 40 lakhs. So if it is within these numbers, then it is considered as a small limited liability partnership, right? Now there is a company. Now the company, what is a company? First of all, if we talk about the companies, voluntary association formed for profit. First of all, it is a voluntary association for profit. It is a perpetual existence. Means if there is a changes in the number, it cannot affect the existence of the company. Okay, shareholders' liability is generally limited to the amount unpaid on their shares. Okay, now if we talk about the company, company is considered as a legal person which is distinct from members and shareholder. Now there are different type of company. Again, important thing, first of all, private company in which the transfer of shares is actually restricted. So there is a restricted transfer of share. Now it has a limited number of members which is 200. Maximum number can be only 200. Minimum is 2 or more. Whereas there is a public limited company. Now, what is a public limited company? Where the shares are freely transferable. There is no limit on the transfer of share. Okay. No restriction on the numbers of member. Okay. Then it is formed by 7 or more person. Okay. So minimum is 7, maximum no. Minimum is 2, maximum is 200, right? Now, one person company is a company which is actually run by only one person as a member, and one person company may lose its status if the paid up capital exceed 50 lakh or the average annual turnover in the three preceding financial year. In the three consecutive preceding financial year, if the annual turnover exceed 2 crore, then it loses the status of 1% company. Now, there is a concept of a small company. What is a small company? So small companies are those companies, first of all, it is other than a public company, and it should have a paid up capital which shouldn't exceed 50 lakh, and it should a turnover that shouldn't exceed 2 crore. So if the turnover is not exceeding 2 crore and paid up share capital not exceeding 50 lakhs, then it is a small. Now, government company, any company in which the central government or state government or partly both, okay, less than 51% a share. Sorry, not less than. Means if there is any company in which the 51% or more share is held by either central or state or jointly by both, then it is known as government company. Then it is known as what? Government company. Clear? Now, type of credit facilities. Now, if we talk about the type of credit facility, there are two type of credit facility: fund-based credit facility and non-fund based credit facility. Fund base, where there is an actual flow of fund from borrower to lender. So bank borrower receives the money directly from the lender. There is flow of cash, like you are giving loan as a banker, you are giving loan. So this is a fund based facility. So there should be a flow of cash okay, flow of money from the lender to the borrower, then it is known as fund-based credit. Like if you have a cash credit, if you have a cash credit, overdraft, term loan, demand loan, and bill finance, these are all considered as what? These are all considered as the fund-based facility. Clear? And okay, now there is a non-fund based facility. Non-fund based facility is the financial arrangement where there is no flow of cash from the lender to the borrower. Instead, they provide some assurance, or they provide some guarantee, right, to facilitate the business transaction. Then it is known as non-fund based facility. Now, if we talk about the non-fund based facility, examples are bank guarantee, letter of credit, acceptance facilities, etc. Clear? Now, last thing, let's talk about the term or demand loan. So, what is the demand or term loan? It is for meeting the expenditure needs of the business. Term loan is actually given in a lump sum payment, granted in one lump sum payment, and these are repaid over a period installments, right? These are classified into short term loan, medium term loan, long term loan. Short term loans are usually repaid within 1 year. Medium term loans are usually repaid between 1 year and up to 5 years, and these are long term over and above 5 year. Clear? So these are the important things I have just discussed, the important thing related to these this chapter, right? Now let's talk about some of the question. The very first question is the share of public limited company are. Four options are given. Just please answer this question. The shares of a public limited company are non-transferable, transferable, sovereign, security, or negotiable. The shares of a public limited company. So if we talk about the shares of public limited companies, these are what? These are not freely. So these are actually transferable. They can easily transfer, right? Cash credit facility is a, if we talk about the cash credit facility, yes, it is a what? It is a fund-based facility, right? Now, all of the above working capital means. What is a working capital? So working capital is what? Yes, it is actually for fulfilling the day-to-day requirement of a business. Going to discuss about this appraisal and assessment of credit facilities. This is PPB Module B Unit 23. So everyone, whoever is watching this session, just please like and share the video to the maximum you can. And if you haven't subscribed this channel yet, it's a request, guys, from my side that please subscribe this channel and press the bell notification icon. Everyone, guys, just please subscribe this channel and press the bell notification icon, right? Everyone, whoever is watching this session, it's a request, guys, that please just like and share the video to the maximum you can. And if you haven't subscribed this channel yet, please subscribe and press the bell notification icon. So this is unit 23 PPB module B, very important. Okay, so let's start discussing this topic. First of all, the what is credit appraisal? So first of all, if we talk about the credit appraisal, so credit appraisal is actually a process of critical evaluation of a loan request. Okay, so it is actually a critical evaluation of a loan request by any of the prospective borrower. So the when the loan, as a banker, you are receiving the loan request, right? So you are critically evaluating that loan request. You are just seeing that whether to accept this loan request or not to accept this loan request. So critical evaluation of a loan request by a prospective buyer is known as the credit appraisal. And what is the primary objective of this credit appraisal? So the primary objective of this credit appraisal is actually to ensure safety and liquidity. Uh, So whether the funds are safe and secure or not, or whether your fund shouldn't be locked up for a very long period of time. You should ensure the safety and security and liquidity of your fund. Then it is known as what? It is known as the credit appraisal, right? Now, if we talk about the essence of the credit appraisal, okay, so essence is you measure the risk that are inherent in the proposal. You are just judging whether to sanction or whether to reject this proposal based on the assessment of information applicant and the project. So what the borrower is coming, what type of profile the borrower has, what is the financial health of that borrower, depending upon all that thing, we are just ensuring the credit appraisal, right? So credit appraisal is what? Credit appraisal is just critical evaluation of the loan profile that you are receiving. Okay, so when you receive any of the loan profile, you want to ensure that there should be safety and liquidity of the fund which you are giving. Plus, you have to make sure that you should be profitable while giving. So, it is a very critical process of evaluating the loan profile, whether to accept this or to reject this, or with what is the risk that is actually inherent in that proposal. You come in final judgment that whether to accept this proposal or whether to reject this proposal, right? So this complete package, you can say, the complete overall package is known as the credit appraisal. This complete process is known as what? It is known as the credit appraisal. Now, credit appraisal, it involves the following steps. Now, what are the following steps in the credit appraisal? First, it actually identified the borrower's identification and verification. So, borrower's identification and verification is necessary. You can access the business of the borrower. Okay, you understand the credit requirement. Your due diligence report is required. You select appropriate exposure scheme, plus you finalize the terms and conditions, right? So this is the step. First, you just identify the borrower. For example, I'm saying that my name is Afreen Azmat and I want to have a loan. I have presented some information. So first, you will identify me as a borrower, as a banker. What is the purpose, what is the duty of yours is first to identify me as a borrower. Second, you have to verify me. Whatever information I have presented to you, you just have to verify whether this information is correct or not correct, right? Then you will assess my business. So if I'm asking for a loan of rupees 20 lakh, you will ensure that your funds would be safe. And how your funds would be safe? If I have an ability to pay back the loan, right? So you just assess the business of borrower. Third, you understand the credit requirements. So for what purpose I'm asking the loan? So you are not giving me the loan just because I'm asking it. There should be specific purpose, and that specific purpose should align with the bank, right? You should due diligence report. You should present a proper due diligence report. Okay, then you will select an appropriate scheme. You will select appropriate exposure scheme, and finalizing, you just finalize the terms and conditions of the credit appraisal. So these are the steps, these are the 6 steps that involve in the credit appraisal. By all these 6 steps, you ensure the safety, liquidity, plus you just what? You just come to a judgment that whether to sanction or to reject this proposal of the loan request, right? Now, there are some credit appraisal techniques that we have to discuss, right? First of all, you have to validate proposal. Validate the proposal means, first of all, verification and validation of the information that are provided by the applicants are crucial. So, for example, I am the applicant. I am providing you some information, right? Said I want to have a loan for starting this business. I have this much income. Okay, I have presented my PAN, I have presented my Aadhaar, my address proof, everything to you. Now, first of all, you should verify it and validate the information that is presented by the applicant. Okay. Next, your information, whatever information I have provided, means as a borrower, I have provided you different information. This information should be cross verified with the supporting document. So if I have said that my income is 5 lakh rupees in a month, I have presented you a PAN and I have presented you my PAN, right? So you just verify my income with my PAN number, right? Field verification is also important. Field verification is also important to eliminate the other further risk. Okay, then you can just check the approvals and license. Okay, so if I want to start a business of food, right, I should have approvals and licenses from the government, and then only the bank is giving me the loan, right? So you have to validate the proposal. Then the verification of applicant's capacity to borrow and authority to request the loan is necessary. So whatever the applicant needs, borrower capacity to borrow, that should be verified, and then the loan is approved, right? So this is the validation of proposal. First, you have to verify and validate information that is provided by the applicant. Then you have your information should be cross verified. Then the field verification should be done. Then there should be checkings of all the license and approvals that should be necessary. So these are all the validations of the proposal, right? Now the credit risk. If we talk about the credit risk, now credit risk means, if we talk about the credit risk is defined as the possibility of the borrowers or counterparty defaults. For example, I am a borrower, right? What is the chance that I will default on loan, or I will default on EMIs, right? What is the chance that I will default on these things? These are considered as credit risk. So credit risk just judge the possibility of the borrower and counter the default, right? Now, default can occur because of the business failure or because of the borrower's willful action. This can be both things. If the borrower is fraud, नियति खराब है. If the borrower is fraud, मतलब उसकी नियत ही खराब है, then obviously he or she will default on the loan, right? Or there's some genuine problem like there's some business failure, there's some temporary cash mismatches due to which he defaults or she defaults. Okay, this can be the reason for the credit risk or for defaulting, right? Now, credit risk rating. First, you after you analyze the credit risk in the borrower side, what is the percentage of defaulting that borrower? Based on that credit risk, you will provide marks, you will provide ratings to that borrower, and depending upon that rating, the loan is sanctioned, right? This is the very first criteria for sanctioning the loan. So credit risk is assessed. First, it is assessed in the form of rating, and then by assigning mark to different parameter, and then evaluating on the basis of some threshold preset standards or task. Right? So this is credit risk rating. Now, what is the criteria for decision? Now, finally, let's discuss about what is the criteria for decisions. Right? So first of all, the very basic and the very first criteria is credit rating score. Okay, right. Everyone, just 1 minute. Okay. The very first criteria for decision is the credit rating. So credit rating score is primary criteria for decision making. It is what? It is the first criteria for decision making. So for example, if you have 750 scores and above, okay, so these are scores which are considered for giving loans. So if you have score like 500, bank is rejecting your loan application based on your credit score. So if you have 750 and above score, yes, you are eligible for borrowing now, right? Now, the lender will also check if the purpose of the loan fits with the credit policy of the bank or not. Means whatever the lender, whoever the lender is, you also check that for what purpose the loan is borrowed, and that purpose if it is fit with the bank or not. Know that for diversifying the risk, bank has already some what limits on the sectors, right? Bank has some limits on the sector that beyond that limits, they are not lending loan to anyone, right? So if you have a very good credit score, and if your purpose for the loan also fit with the bank's purpose, right? But even after these two things, lending you loan will breach threshold limit, which is set by the bank for each sector to diversify the risk. If it breach that limit, then the bank will reject your application, right? So this can solely the basis for the rejection of your loan application also. So this is the criteria for decision, credit rating score of the application. Okay, then for what purpose you are borrowing loan, and if it is within the concentration limit that is prescribed by the bank, or it is within the concentration limit of not, right? If we talk about the next thing, now aspects of the appraisal. Now there are four cardinal principle of lending. I have already told you the six cardinal principle of lending in the last class, right? If you all remember, in the last session I have told you there are six cardinal principle of lending. Okay, under this six cardinal principle of lending, there is only four cardinal principle of lending which is written here. Four cardinal principle of lending which is already written here. Now let's discuss about these four cardinal principle of lending. First of all, evaluation of credit worthiness of the borrower. Yes, you will check the credit worthiness of the borrower. Then you will check the purpose of the loan. Then you verify the cash flow and the sources of repayment. And last, you will assess the security and collateral security. So these are the seven C's, or these are, you can say, the four cardinal principle of lending, right? Now, there are seven C's to judge the security of your fund. So for judging that your fund should be secured or not. So there are seven C's to judge the security of the loan that you are lending. Now, what are these seven C's? Credit worthiness, character, capacity, capital, collateral, condition, cash flow. Very important, you guys. These are very important for all of you. Clear? Now, next, if I talk about the working capital, okay, so working capital, the capital for the business enterprises, these are classified into two categories. So, the working capital, these are actually classified into two categories. First is the fixed capital, and second is the working capital. Okay, so fixed capital means which is fixed, which you need to incur, right? Which you cannot escape, you need to incur this capital. This is known as the fixed capital. Whereas there is a working capital which is required for meeting your day-to-day expenditure. So there is a fixed capital, like for example, rent. Rent is a fixed capital that you need to incur, right? Working capital means you are just purchasing the raw material, right? So these depend upon production activity. If the production activity is high on demand, then obviously the working capital will be high, right? So first of all, if we talk about the working capital, so there are two concepts of the working capital. There is a gross working capital and net working capital. Okay, so if we talk about the gross working capital, it is actually the total capital which is invested in the total current asset. Now, what is current asset? Current assets are tangible. Tangible means which can be touched, which can be felt, right? So these are tangible, movable assets that are recoverable in cash or consumed or turned over during the operating cycle. It will usually not exceed 1 year. It will not exceed the 1 year. Okay. So gross working capital is what? So gross working capital is actually the capital which is invested in the total current assets, right? So current assets are what? Current assets, these are tangible, movable assets, and these are recoverable in cash or sold or consumed or turned over during the operating cycle, which usually doesn't exceed 1 year. And what is net working capital? Very important. Net working capital is current assets minus current liability. Net working capital is excess of long funds over long term uses. It is actually excess of current assets over current liability. Okay, so there are two concepts of the working capital: gross working capital and net working capital. Clear? Now, next, if we talk about the components of the working capital, what are the components of the working capital? So there are six components of the working capital. Now, six components of the working capital is raw material. There are raw material, stock in progress, finished goods in stores and transit. There are other consumable stores. There are receivables and sundry debtors, and there are other expenses. These are the components of the working capital. Okay, working capital is also known as operating cycle. You all remember that working capital is also known as what? It is also known as operating cycle. Very important question can be asked from here. Now, this is the operating cycle, which usually doesn't exceed 1 year, right? So there is a cash, right? We have cash. Now cash is converted, cash is used for purchasing of the raw material, then raw material is put into the work in progress. Okay, now it is converted into finished product. Now this finished product is sold into the market, and for example it is sold to the debtor. Now from debtor the cash is again recovered. Now again the cash is converted into raw material, then it is again into work in progress, then finished product. So this is known as what? This is operating cycle, or this is known as working capital cycle. Both are clear. Now, next is what? Next is a term loan. Next is what? A term loan. Now, term loan is actually given for the acquisition of capital assets. Okay, so if you want to acquire some capital asset, if you want to acquire some land and building, plant and machinery, modernization, renovations of the plant, you have any of these. You have to just purchase any land and building. You have to just purchase any plant and machinery. You have to modernize. You have to renovate the plant, right? For all these purpose, the term loan is actually granted. Okay, and you normally, if we talk about the term loan, these are repayable over installment. Okay, so lump sum payment is given because you have to pay for purchasing of these things, right? And lump sum payment is actually given, right? So if we talk about the term loan, these loans are actually for a longer period of time. Term loan can be medium short as well as long term also. But usually the term loans are given for a long period of time that range between 3 years to 10 years. Okay. And the credit risk therefore is greater in the case of term loan than in the case of working capital finance. So bank are providing the working capital finance also, but this is usually more on a short to medium term basis, right? But if we talk about the term loan, it is usually provided on a long term basis. Okay, it is provided for a period or range of 3 to 10 years, and it is provided for a period of less than 3 year working capital finance. And the risk, if we talk about the risk, obviously risk in the term loan, because it is for a greater period or longer period of time, it is more than the working capital finance. Clear? Now, for providing the working capital or for providing the term loan, you should assess the project cost. Okay, require the estimation of the capital assets, cost of construction of the building, and other related expenditure, as well as there can be some margins also which can be given in the term loans, because see, the term loans are based on estimate. But obviously if you are building anything, anything that goes south and you will need more of money, so there is always some contingency fund, or you can say margin, which can be set up and which is actually there for granting the term. Going to discuss about this type of collaterals and their characteristics. Okay, so type of collaterals and their characteristic, this is unit 25 PPB module B. Okay, we are going to discuss about the different type of collateral that a debtor is giving to the bank or a lender. Okay, and what are their characteristics, and what a bank, as a banker, what they need to take care while accepting the collaterals, right? So this all we are going to discuss in this chapter. Okay, everyone, guys. Okay, so let's start discussing first of all the difference between the secured loan and unsecured loan. So what is a secured loan and what is an unsecured loan? Okay, so very simple thing. So if you all know what is secured loan, and if you all know what is unsecured loan, very simple things. Secured loan are those loans which are actually backed by collaterals. These are those loans which are actually backed by collaterals. Okay, these are those loans. Okay, unsecured loans are those loans which are granted without any security. These are granted without any collateral. Okay, so secured loans, these are granted with collaterals, and unsecured loan, these are those loans which are granted without any collaterals, right? Now, if we talk about the secured loans are always backed if we talk about the secured loan, so there is always the guarantee that has been given. A bank actually are assured of the recovery, and so they are less risky. Right? So they are what? They are very less risky secured loan. But unsecured loan, these are risky. If we talk about unsecured loan, these are more risky. Okay. Third, if we talk about the secured loans, because it is granted with collateral, obviously they attract less interest rate. Okay. But if we talk about the unsecured loan, they actually attract more interest rate. They actually attract what? They actually attract more interest rate. Okay. So granted on the basis of these are granted on the basis of borrower's future financial strength and assets which are provided as a collateral. And these are actually reliable asset for the repayment assurance. Asset serves here as a security and can be sold by the bank for recovery. Most bank loans in India are secured by the tangible assets like property and bonds and shares or merchandise, right? Now, unsecured loans, these are granted without any security or collateral. These are those which are granted without any security or collateral. Okay. And they relies on what? They relies on the borrower's personal integrity. They relies on the credit worthiness and confidence in the repayment. Very important things are unsecured loans are considered as a clean loan. If we talk about the unsecured loan, they are considered as a clean loan, and the recovery depends upon the borrower's financial strength and integrity. This actually depends upon what? Borrower's financial strength and integrity. Clear? So these are the secured loans and these are the unsecured loans. Okay. Now, if we talk about the types of securities, okay, so types of security, what are the different type of securities which are accepted as a collateral, which are accepted as a collateral? So first, there can be an immovable assets. Immovable assets means which cannot be moved. There is a movable assets which can be accepted as a security. There can be actionable claims. Actionable claims means which you can claim. Okay, if you are, for example, there's any insurance policy and you are receiving that insurance policy, and if you have kept it as a collateral to the bank, this is an actionable claim. It means that whatever the proceeds you are receiving, the bank can claim it legally, okay, from you. This is an actionable claim. Or there can be the intangible assets. Okay, so there can be what? There can be the intangible assets also. So type of securities are immovable assets, movable assets, actionable claim, and the intangible assets. Okay, so now whatever the nature of the collateral is, bank need to take care of the certain things before accepting it as a collateral. This is very important. Bank need to take care before accepting anything as a collateral. So what are the important characteristics that bank need to take care before accepting anything as a collateral? First, it must be saleable. First of all, it must be what? It must be saleable. Okay. Saleable means it if the borrower's default. If the borrower's default, it must be recovered. Right? Second, if we talk about the value should be ascertainable. The values should be what? The value should be ascertainable. Third, its value should be reasonable stable. Its value should be what? It should be reasonably stable. Right? Fourth, if we talk about the fourth thing, it is easily transferred without any extra legal formalities. If it is easily transferred, obviously it is a big one. It is a big thing. Okay, so these are the four things. It should be saleable, it should be ascertainable, it should value should be stable, and it should be easily transferable. It should be what? It should be easily transferable. Clear? Okay. Now, if we talk about the land building as a collateral is accepted nowadays with very enthusiasm by the bankers, but earlier it was not accepted. Very bank was very negative and accepting the land and building as a collateral, and there was a reason for that. Okay, the reason for that is because there was lot of formalities for the selling of land and building if the borrowers default, and so back in the olden days, was very much averse to accept land and building as a security. Okay, but this concept changed over time. This concept actually change over time, and nowadays banks are accepting them as a collateral. Right now, under this SARFAESI Act, if we talk about this SARFAESI Act, under this SARFAESI Act, when there is a freedom that has been given to bank to sell any immovable property without any the intervention of the court, when this actually given this freedom has been given to the banks, then banks are nowadays very much accepting bank as a collateral. They are accepting land and building as a collateral very happily. And the very positive thing with the land and building as a collateral, that is value increases over time. So if you are accepting land and building as a collateral, you cannot be in the loss segment. Why? Because see, land and building, these are appreciating in nature, and when these are appreciating in nature, obviously you will get more return. Okay, you will not get less return. Your whole loan money will be recovered from this land and building. The second thing, it cannot be moved. It is an immovable thing, so obviously, so it can be traced. Okay, you cannot hide this thing. It can be traced. So land and building are accepted as a collateral with very enthusiasm nowadays after the introduction of SARFAESI Act, after the changes that has been introduced in the SARFAESI. Okay, done. Now next, if we talk about the advance against life insurance policy. Okay, advance against what? Advance against the life insurance policy. Now, life insurance policy is an actionable claim. You know what is actionable claim? I have already explained you. And it can be a primary or secondary collateral. Sorry, give me 2 minutes. Excuse me, 2 minutes. So, if we talk about this life insurance, right? So, life insurance policies can be accepted as a primary as well as a collateral security. Primary as a main security, collateral means accepted with any other securities, and it is an actionable claim. If we talk about life insurance policies, business, these are highly regulated and permitted to only few companies. These are highly regulated entities, and these are permitted to only few companies. So obviously, there is no or very less chances of default. Okay, bank are actually assured of the financial health, and bank need not doubt to the resolution of these policies. Okay, if we talk about these policies, the assignment of this policy in the favor of the bank requires very few formalities. It actually requires very short, very few formalities, and bankers obtained a perfect title for this. Okay, the security. This security, that life insurance policies, these are very easily claimed soon after you default. Okay, so these are very easily claimed soon after your default, right? So these are easy way of collaterals of recovering the money in the case of the default. But there are certain life insurance policies which are not acceptable as a security. There are certain life insurance policies which are not accepted as a securities, right? There is a children endowment policy. There is a policy which are taking out specifically for the purpose like estate duty. There are children deferred policy. There are policies with the nomination under Section 6 of the Married Women Property Act. So these are considered first. These are not accepted. These are not accepted as a life insurance policies collateral because of the certain conditions attached to them, right? Now, advance against share, yes, the advances has been given against the shares also, right? So typically there are two type of shares, equity and preference share, right? Equity shares hold a voting right, preference shares do not hold a voting right. If you are holding the equity share, you can participate in the management, whereas if you are holding the preference share, you are not allowed to participate in the management. Preference shares are given preference over the equity, right? So further, there are equity and preference share, and if we talk about the further classification, yes, they can be listed as the listed shares also, and they can be listed as unlisted shares also. There are listed shares also, and there are unlisted shares also. Okay, bank accept generally accept the listed equity shares as a collateral. Okay, bank can also accept the listed preference share as a collateral also. Okay, but they are not accepting unlisted shares as a collateral, right? If we talk about the banks, bank can demand either a loan. Okay, bank can provide either a demand loan or an overdraft facility against the security shares. Okay, the shares nature is actually pledge. Pledge means you have to transfer that share in the form of demat account to the bank, right? Advances, whatever the loan that has been given, the loan is given against the shares, fully paid shares of a public limited company. Okay, so if there is a private limited company share, no loan is given against the share of the private limited company. Bank should assess the marketability of the shares also. If you talk about the valuation of the shares, the valuation of shares, it's depend upon the current market price, prevailing market price. It is not dependent upon how much value you have received for that share. If it is current, what is the current value? The valuation of shares is taken on current value. Bank should ensure compliance with the statutory limit. If we talk about the bank should determine their capital market exposures, right? So these are the advance against the share. These are actually the advances against share. Now, next, if we talk about the advance against the debentures. Advances against the debenture, first of all, debentures is what? Debenture is a document which is issued by the company to acknowledge its indebtedness. To acknowledge its what? To acknowledge its indebtedness. Okay. If we talk about the fixed rate of interest, fixed rate of interest is actually payable at the stated periods of the debenture. So debenture. So thing is, first preference is given to the debentures, then it is with the preference, and then it is with the equity. So if there is any stage of insolvency, first the debenture holders debts are cleared, then the preference shareholder, and lastly the comes with equity shareholder. Okay, and because it represents the indebtedness of the company, obviously there is a fixed rate of interest that is payable for a stable periods of the debenture. If we talk about the debentures are especially easy when they are very listed. So they are easy to sell. Debentures are very easy to sell if they are listed, and their prices are not subject to the very price fluctuation, and they can be transferred at a very minimum cost. They can be transferred what? They can be transferred at a very minimum cost. Okay. If we talk about the bearer bearer debentures. Bearer debentures are fully negotiable. They rank higher in priority to the share and generally secured by a charge on the company's property. If the interest is not paid regularly, if we talk about the interest, if the interest is not paid regularly on the debentures, it would affect the price and marketability. The nature of the debentures must be uncertain. The nature of the debentures must be what? Must be uncertain. Okay, whether they are unsecured or whether they are secured. The borrowing powers of the company issuing the debentures must be uncertain and to verify the same has not been exceeded. Right? So these are the advances against the debentures. Now, yes. Loans against the term deposits. So if we talk about the loans against the term deposits is what? Okay. So term deposit. If you are holding the term deposit of the same bank, then you are eligible for the loan, right? But the loan cannot be given against the term deposits of any other. So for example, if you are holding the term deposits or in HDFC Bank, yes, you are allowed to have loan from the HDFC Bank. You cannot apply for the loan to SBIs, right? And obviously, the nature is pledge. In this case, the nature is pledge. Normally, the bank is giving 90% of the deposits. Normally, a bank is giving what? 90% of the deposits. Okay. For example, if you have 1 lakh rupees in the term deposit, the bank is giving only 90,000 as a loan against this collateral. No loan can be granted if the securities or there is a deposit in the name of the minor. Okay, however, if the loan is given for the necessities of the minor, right, then the bank can recover it from deposits, right? Now, loan cannot be granted against FD which is held by any other bank. This I have already explained to you. This is because the bank who received the deposit will have a general lien over the monies, right? Next thing is loan against the gold ornament. These are the most common type of collateral, gold ornaments. Okay, the nature of charges obviously pledge. You have to transfer the possession to the bank, right? Now, in this, the bank allows overdraft facility against the security of gold. Normally, the loan to value ratio is 65%, and a loan cannot be given against the raw gold or pure gold. Okay, but if it is a coin or if it is a minted coin, then this can be given as unsecured, right? But if in the case of default, after giving a very reasonable time to the borrower, the bank can sold off or sell the gold off and recover the loan from that. And this permission has been given under Section 176 of Indian Contract Act. Clear? Now, last is the vehicle finance. If we talk about the vehicle finance, vehicle are being financed obviously for the personal use as well as for the commercial use, and the time period is 3 to 5 years. The valuation is easier, they are durable, right? And the vehicles are hypothecated. Hypothecated means you don't have to transfer the possession without transferring what? Without transferring the possession. Clear? So this is the vehicle finance. Okay. So this is it. This is the complete chapter, and I have discussed the most important thing related to this chapter. Okay. First, now let's talk about some of the question. The first question is loan to value ratio in the case of gold loan is what? The loan to value ratio in the case of gold loan is what? Okay, gold jewelry is what? 50%, 75%, 100%, or 85%? Everyone, please answer the question. The loan to value ratio in the case of loan against gold jewelry is what? Everyone, please answer this question. Loan to value ratio against the gold jewelry is what? The loan to value ratio against the gold jewelry is what? So if we talk about the correct answer, yes, the loan to value ratio against the gold jewelry is 75%. So B is the correct answer. 75% is the correct answer. Okay, next. Loan against the minor term deposit. It can be granted if the documents are signed, if the minor has completed the age of 14 years. It cannot be granted under any circumstances the minor does not have the contractual capacity. Can be granted to the guardian of the minor if it is for the necessities of the minor. It can be granted only with the permission of the court. Loan against minors term deposit. Everyone, please answer this question. Loans against the minor term deposit, I have already explained you. So loan against the minor term deposit, it can be granted, okay, if it is for the necessities of the minor. So C is the correct. This is different modes of charging securities, unit 26. We are going to discuss the most important part related to this chapter. Everyone, it's a kind request from my side before starting this session that please like and share the video to the maximum you can. And if you haven't subscribed this channel yet, it's a request that please subscribe this channel and press the bell notification icon, everyone. Okay, hello everyone. Hi guys. Okay, so let's start discussing this topic. Okay, the first is the meaning and essentials of the contract. First is the meaning and essential of contract. So what is a contract? If we talk about contract, what is this contract mean? So if we talk about the law which is governing the contract in India is the Indian Contract Act 1872. So Indian Contract Act 1872, they are governing contract. So the contract is actually divided into two parts. This act is broadly divided into two parts, part one and part second, right? So part one means these are the general principles of a contract which is available, applicable to all types of contract, right? The second part deals with the special types of contract like indemnities or guarantees. These are the special types of contract. Okay. Part two is actually related to the special type of contract, and part one, these are applicable to all type of contract. So if we talk about the contract, what is the meaning of contract? So contract are those agreements which are enforceable by law. Enforceable by law means that if there is a default which happens from the counterparty, so if the default happens from any of the counterparty, you can go to the court against that party, right? This is known as enforceability, means it has legal obligations. You can go against that party in the right. It has some major constituents, right? So what is a contract? First of all, it should be an agreement between two or more person, and the agreement should be enforceable by law. It means that they have the rights and obligation arising out of it. Now there are certain characteristics which need to be satisfied for enforceability. So there are certain things which need to be satisfied for foreseeability. Like, first of all, it should be made by the free consent of all the parties. So, whatever the parties are, it should be made by the free consent of all the parties. There should be a lawful consideration for these. There should be what? There should be a lawful consideration for these. It should be made with a lawful object. Okay, so you are making an agreement for a lawful object. Okay, nothing which are restricted or which are not allowed legally. Last, it should not be declared as a violent, which are expressively mentioned in the Indian Contract Act. Like, for example, if there is an unsound person, okay, unsound mind person, if there is a minor, if there is a insolvent person, right? So these are those person to which actually the contract is not valid. If you are making an agreement with any of these, it is not valid. It is void ab initio. It means that it is not valid from the very first step. So these are expressively mentioned in the Indian Contract Act that agreement made with unsound mind, minor or insolvent person, these are not violent, right? So it should be made by the free consent. Lawful consideration should be given. There should be a lawful object, and it should not be declared as a buyer, which are expressively mentioned in the Indian Contract Act. Clear?
Now, next, if we talk about the meaning and essential of the contract, now, meaning and essential of the contract, all agreements. So, this is very important. See, agreement is a very broader term, right? Under agreement, there are various agreements between the parties, and these are actually two categories. Some are enforceable by law, and some are not enforceable by law. Some are enforceable by law, and some are not enforceable by law, right? So if we talk about the agreements, if we talk about the agreement, these are should be made by the free consent of the parties, and there should be enforceability for a contract. So if we talk about this situation, yes, contract are those agreements which are enforceable by law. So by this we can come to a conclusion that all contracts come under agreement. Yes, because under agreement there are portions which are not enforceable and there are portions which are enforceable, right? So those which are enforceable, these are contracts. So all contracts are technically agreement, right? But all agreements are not contract. Why? Because under agreement there are both enforceability and non-enforceability. So all those agreements which are enforceable, only those agreements are contracts. So all agreements are not necessarily to be a contract, but all contract are agreements. So if we talk about this figure, this is very important. Just see this. This is an agreement. This is an agreement. Okay, and this is enforceability by law. So agreement and enforceability, when these intersect, these are considered as the contract, right? These are considered as the contract. So contract are those agreements which are enforceable by law. Clear? Everyone? Yes or no? Yes or no? If you have any doubt, you can ask your doubt. Everyone, if you have any doubt in this, you can ask your doubt. No doubt? Clear? Everyone? This is a very important slide. See, you can get a very good quality questions, case studies from these slides. So you need to focus on these concepts, okay? Contracts and agreements. These are very important from the examination point of view, okay? Now, next, if we talk about the key components of a contract, now what are the key components of a contract? So, when a person signifies to another person his willingness to do or not to do something with a view to obtain the consent from the other parties, then it is known as what? Proposal. So, when any person signifies to another person that his willingness to do something or his willingness to not to do something, right? To do or not to do something with a view to obtain the consent of the other person. It is actually with a view to obtain what? To obtain the consent from other person. This is need to be, or this is known as a proposal, right? And when a person to whom the proposal is made, when a person to whom the proposal is made signifies his consent, accept that proposal, then it is known as accepted. And when a proposal is actually accepted, it becomes a promise. So there are two concepts. There is proposal, and when proposal is accepted, okay, then it become what? Promise, right? So the one who is making the proposal, okay, but who is initiating or making the proposal, he or she is called as the promiser, and the one who is accepting is called as a promisee. The one who is accepting it is called as a promisee. So these are the key components of a contract. These are what? These are the key components of a contract, right? Now, essentials of a valid contract. So now what are the essentials of the valid contract? There is each and everything which is important in these slides. So kindly just please focus on these slides, because you will get questions from here in the examination. And obviously, this is very important to understand. Okay. So let's start. What are the essentials of a valid contract, right? So, first of all, there is a proposal and there is an acceptance. So, one is proposing and one is accepting. When the proposal is made and when it is accepted, then it become what? It become a promise. Then it become what? It become a promise, right? An agreement, it can be oral or it can be in written. There are two things. An agreement, it can be oral an agreement can be in written, right? There should be a consideration. It should be made with the free consent of party, and that person should have a capacity to contract, right? Last, the minor contract. So very important thing, an agreement which is made with the minor is considered as void ab initio, means it is invalid from the very initial stage. Invalid from the very initial stage. So it is actually invalid for the very initial stages. Right? Now, if we talk about this, the principle behind that is that a minor is supposed to have a mature judgment and is not supposed to have a mature judgment, and hence he cannot decide what is good or bad for him. And that's why a minor not liable to perform any promise made by him under the agreement. So the contract which is made by the minor, it is actually void ab initio, means it is actually invalid from the very initial stages. It is invalid for the very first stage, right? Now, if we talk about the contract of agency, if we talk about what? If we talk about the contract of agency. Now, if we talk about the contract of agency, the agent and principal, these are defined under Section 182 of the Indian Contract Act 1870. Okay, Section 182 of Indian Contract Act of 1872. Agent is the person who is acting on the behalf of the principal. Principal is the person who is giving instruction to agent. Principal always give instructions to whom? Instructions to agent. And agent is the person who is acting on the behalf of the principal, right? And the contract between the principal and the agent is the contract itself, right? And it is governed by the normal rules of the contract. Now, what are the authority of the agent? If we talk about the authority, it can be expressed, it can be implied. Expressed means it can be written, and implied means it is understood. It can be understood, right? Next, the extent. You have to define the extent of the authority of an agent. What is the extent of the authority of the agent? If we talk about the emergency, yes, it is in the case of emergency, what is the agent who is acting on the behalf of agent, right? There is no delegation of the authority. And if you exceed the authority, what is the decision of the principal? Now, what is no delegation? No delegation means, for example, if I have given some work to the agent, right? On my absent, you have to perform this function. Now, it is important to note that you as an agent cannot move this function forward. There is a no delegation of authority. If I have made a contract with you as an agent and principal, so you are responsible for executing that task. You cannot forward this task to anyone else. So this is known as no delegation of authority, right? If we talk about the termination of agency, so in which cases the agency is terminated? Okay, so first of all, the principal himself or herself revoke his authority, right? Second, the agent renouncing giving up the business of the agency. Third, the business of the agency being completed. Fourth, either the principal or the agent dying or become unsound mind, or the principal become an insolvent. So in all these cases, there is the termination of the agency, right? So this is the important part of this chapter. See, I have just explained a very important part of this chapter. I have not completed the whole chapter. See, whole chapter is actually completed once every in the paid class, right? So the whole chapter is actually completed in the paid classes, right? Chapter today, that is the documentation. So this is a easy topic. Okay, documentation, we are starting this today. Documentation, this is unit 27 PPB module B, right? So let's start discussing this topic. Okay, we are going to discuss this complete chapter because this is a very easy chapter, very short chapter. You have to just take care of the things that which steps comes after which step. Okay, so this is the main thing. You have to just take care of which step comes after which step. Okay, so let's start discussing this topic. First of all, if we talk about the basic introduction. So just ignore this heading first of all. I'm just taking this. Okay. So yes. So first of all, just talk about the basic introduction. See, what is the basic introduction for why the documentation is needed? Okay, so if we talk about the documentation, documentation is the most important aspects of all the credit management in a bank. So the complete credit management in a bank, when we are talking about the all the credit management of the evidence related to each and every credit facility the bank is giving to the borrower, everything. So everything is judged on the basis of what? Documentation. If you have the documentation, that you have the legal authority to take any action against the defaulter. If you don't have the documentation, then you cannot take any legal steps. Why? Because you don't have any evidence. So this documentation is actually acting as an evidence against the financial services which the bank is given to their customer. It is very important for the bank to preserve the documents, each and every document, in a very good condition. Why? Because this is the sole evidence you need when you are taking any legal action against a defaulter, right? If we talk about the documents, first of all, what is the need for document? Need for document, the first thing is why the document is needed is to identify the borrower. First of all, the documentation is needed to identify the borrower. Okay. Second, it actually identify the security, right? First of all, the borrower is to be identified. Second, the security is need to be identified, right? Then you should have a written evidence of the transaction. Okay, so you should manage a written transaction on the or written transaction made by the bank. So it is a written evidence of all the transaction made by, right? Next is to ensure that there should be a due repayment of the loan by the borrower. Okay, so there should be a due repayment of the loan by the borrower or the guarantor. You should entitle that the bank should take a legal step for the recovery of the loan. It actually create a valid and effective security in favor of the bank. Valid and effective security in favor of the bank. Clear? Now, next, if we talk about the next thing, different types of documents. So, what are the different type of document? If we talk about the different types of document, the very first is the demand promissory note. Now, demand promissory note is issued when there is no repayment time period fixed in the case of loan. So in the case of loan, when the repayment time period is not fixed, when the repayment time period is not specified, then it is known as what? Demand promissory note. Okay, demand promissory note. In a demand promissory note, the borrower actually make promises to the banker that whenever the banker demands, the debtor is actually returning the loan with the agreed rate of interest. So it is only issued. It is actually a promise note. And why this is issued? Because the repayment time period of the loan is not fixed. So when it is not fixed, the repayment of the loan is not specified, then it is the demand promissory note. And always remember, it is according to Section 4 of Negotiable Instrument Act 1881. It is actually in accordance to Section 4 of Negotiable Instrument Act 1881. If we talk about this demand promissory note, they attract a uniform stamp duty. Okay, demand promissory note, they attract what? They attract a uniform stamp duty, and this will be filled and stamped before the borrower sign. So it is actually filled, it is actually stamped before the sign of borrower, right? Next is an agreement. Now, agreement, it is governed by the Indian Contract Act. Okay, it is accordant with what? It is accordance to the Indian Contract Act. Demand promissory note, it is according to the Negotiable Instrument Act. Demand promissory note, it is what? It is according to the what? It is according to the Negotiable Instrument Act. But if we talk about this is actually by according to the Indian Contract Act. Terms and condition of the loan is actually specified in the agreement. Terms and condition means what is the amount of loan, what should be the rate of interest charged, okay, what is the rate of penal interest, okay, what is the percentage of margin. Everything should be in this agreement, and this agreement attracts a stamp duty, and this stamp should be there as per the Indian Stamp Act. So this agreement, it attract a stamp duty, and this stamp duty is per the Indian Stamp Act. Clear? Now next. If we talk about the next thing, forms, okay, forms are not in the nature of promise or agreement. So always remember, forms are not in the nature of promissory note, neither it is in the nature of agreement. They are simply to clarify or clear the intention of the borrower. They actually issued to clarify the intention of borrower. So if I'm giving you example, that if the loan is granted against the security on FD, right, and this FD is in the joint name, and if one depositors want to take a loan against that FD, the other depositor has to give an authorization, and such authorization and confirmation should be taken in a form. Okay, so form is neither a promissory note, neither it is what, neither it is an FD. Clear? Next, if we talk about the documentation procedure, if we talk about what? If we talk about the documentation procedure, so the selection of the correct set of documents. First of all, the selection of the correct set of the documentation. So as a banker, you need to select a correct set of documentation. So documents differs from different financial service to financial service, as plus as different customer to customer. For example, the documentation process which is needed for individual, they cannot be same as what is needed in the partnership or companies, right? Or for example, the document which is needed for overdraft facility may not be same as the documentation which is needed in, for example, you can say cash credit or loan, right? So every financial service has its own set of documentation. Plus every individual or company or firm or partnership, they have another set of document. So as a banker, this is your first responsibility, that you have to choose the documents as per your conditions, right? So what the customer is demanding to you, what type of customer he or she is, depending upon that, you have to select the correct order of documentation. Then after selecting a correct road of documentation, you have to stamp the document. After selecting a correct code of documentation, you have to stamp the document. So the next step of the documentation is stamping, and this stamping should be done as per the Indian stamp. This stamping should be done as per what? Indian Stamped Act. Okay. Third, amount of the stamp duty. So while stamping the document, you should be very aware of that how much amount is involved in that stamp duty, right? So it depends upon whether the subject is central government subject or a state government subject. For example, there are promissory note, there are bill of exchange, there are a share transfer, receipt, letter of credit, policy of insurance. These are the central subject, so it attract a uniform amount of stamp duty, right, in all the state. You are stamping it in any state, you will track the same duty because this is the central subject, right? But some subjects are state subjects, like there is a hypothecation, there is a pledge, power of attorney, lease, mortgage. These are the subject matters, and that's why the stamp duties are different in different states. So you need to take care whether the stamp is on, you can say whether the stamp is the central stamp or the state stamp, right? Filing. If we talk about after stamping, the filling is done, not filing. Filling is done. So the documentation procedures involve the filling of the document. So are appropriate blanks which are given in front of something. Like for example, name is given, and there is an appropriate what? There is an appropriate blank which is given, right? A date and appropriate blank, right? So you have to fill the appropriate blank with the right, with the terms and conditions. So as a banker, this is generally very important that you have a pre-printed format of document. You have to fill that document with the blanks in an appropriate places as per the term and condition which are specified in the documentation. Clear? Hmm. After filling, there is a execution. Execution means signing. After filling, you have to sign the documents. After filling, you have to do what? You have to sign. You have to do the signature in the documentation process. So the next step in the documentation is the execution or signing of the documents, right? Now, in some cases, so this legal procedure is not in every case, always remember. This is in some cases, not procedure, what I'm writing. Just please wait. So, in some cases, okay, there are extra legal procedures after the execution. Once you have filed, you have filled the documents, you have signed the document, then there are some cases in which you have to go through for some legal procedures. Some legal procedures, some extra legal procedures are required after executing the document. For example, in the case of advanced to limited companies against its asset, the documents or forms need to be presented in front of a registrar of a company. So this is not in every case. This legal procedure are present in some of the states, right? Now, you have to keep the document valid or you have to keep the document in force. Now, this is again very important. There is a limitation period for the recovery of debt in India, which is actually governed by the Limitation Act 1963. Now, Limitation Act 1963 specifies that there are certain prescribed time period within which you are allowed to file an application or suit against the defaulter party. Okay. Now, a banker is only allowed to take legal action within or file a suit or prefer an appeal anything when the documents are within the limitation period. So, if the documents are expired, okay, the banker cannot take any legal action to recover the dues. For example, if we talk about the period of limitation for the documents, so it is 3 years for the execution date for demand promissory note and 12 years from the execution date from a mortgage loan. So it is very important that as a banker, you should be aware of the limitation period. And once you want, if there is any default and you want to file an application or appeal or anything against the defaulter party, you should do within the limitation period. Like for example, in the case of demand promissory note, from the date of execution, there is a time period of 3 years. You can file you can just file an appeal against the defaulter party within this 3 year. If this 3 year time lapse, then there is no legal thing. You cannot file an appeal against that. So you should be very important that you should be aware of all the limitation periods of the document. Next, you have to renew the document. So before the expiry of the documentation, a very important step that need to be taken is the renewal of the documentation. So you need to renew the documentation, okay, before the expiry of the document. And last is safekeeping and preservation of document. Obviously, loan documents, these are very valuable to the bank as they are the evidence. Very important thing. They are the evidence to claim, right? Nowadays, bank gives loan for a very long period of time. Say sometimes in home loans, there are 20 years or even 25 years. Now, this actually requires that such document be preserved for a longer period of time, and hence that document should be stored securely and properly. Care should be taken and that it is kept in a fireproof, pilfer-proof cabinet and strong room, okay? And there should be a responsibility and accountability of the document which are kept in personal custody of an authorized officer, right? So this is the documentation procedure, okay? This is the complete chapter. I have already told you that this chapter is very small, very easy chapter, okay? So let's discuss of the practice question. So as per the Stamp Act, a document is executed in India shall be stamped only before the execution, at the time or before filing, okay, within 30 days of execution or before or at the time of execution. Okay, So actually, when the things are stamped, stamping is done after the execution. Okay, once it is executed, if we talk about the stamping, yes. So execution is actually what? Execution after the stamping. Okay, after the stamping, execution is okay. So after the stamping, before or at the time of execution. So yes, a document is executed in India shall be stamped before or at the time of execution. Yes. So stamping is done after the execution, right? So it is before or at the time of execution. So D is the correct answer. Okay, so today we are going to start Unit 28 for PPB. This is PPB Module B, Unit 28, that is non-performing assets or stressed assets. Okay, so we are going to discuss about this topic in today's session. Okay, so first of all, let us discuss about what is a non-performing asset. Let us discuss about the thing what is known as non-performing asset. So non-performing asset, an asset which actually ceases to generate income. Non-performing asset means any assets which actually ceases to generate income. Okay, because you know that when a bank is giving loan to a debtor, right, to any customer, to any debtor, when a bank is giving loan to a debtor, then this loan is actually what? This loan is actually considered as the what? This loan is actually considered as the assets for the bank because they actually earn income from this loan, and this actually considered as a liability for a debtor. So non-performing asset is said that any those income or any those assets of the bank which actually ceases to generate income, which actually does what? Ceases to generate income, then it is known as what? Then it is known as non-performing asset. Okay, now non-performing asset has different categories. If we talk about the non-performing asset, non-performing asset has different category. First of all, the interest or installment of the principal which remains overdue for a period of more than 90 days. So if you have any principal amount pending, if you have any EMI pending, if you have any principal, or if you have any EMI which is pending for a period of more than 90 days in respect of a term loan, then it is considered as non-performing asset. Then it is considered as what? Non-performing asset. Second, when your account remain out of order in respect to overdraft or cash facility. Now what is this out of draft means? Out of order means, so out of order means, first of all, when you have any cash credit or overdraft facility from the bank, right, but it is out of order when outstanding balance is excess of the sanction or drawing limit. For example, you have 1 lakh as a sanction limit, as a cash credit limit or overdraft limit which is given to you, right? But you have withdrawn more than your sanction limit. You have withdrawn 2 lakh rupees, right? So this is withdrawn is actually more than your sanction limit, and this is continuously for a period of 90 days. For example, you have withdrawn uh, excess over and above, you can say you withdraws over and above your sanction limit today, but you have submitted some money and just make it balance, okay, tomorrow, then it is not considered as out of order. Okay, right? So when there is cash credit and overdraft facilities and the account which is remain out of order. Clear? So out of order means when in excess, if we talk about in excess thing, so in excess means what? In excess means your account, you have withdrawn more than your sanction limit. Okay, this withdrawal is actually continued for a period of more than 90 days, right? Next, outstanding balance is actually less than your sanction limit. The outstanding balance is actually less than your sanction limit, but there are no credits that allow continuously for a period of 90 days. Second case is when you have, for example, 1 lakh as your withdrawal limit, but you have withdraw only 80,000 baht. You haven't credited any money continuously for a period of 90 days, right? Or even if you have credited something, it is not enough to cover the debt for the previous 90 days, or it is not enough to cover the interest for the 90 days. Then it is known as out of order status, right? So, first of all, a non-performing asset is any asset or any interest or installment which is pending for a period of more than 90 days, right? Second, if you have any EMI or if you have any account which is out of order status, okay, it is out of order status in respect of overdraft and cash credit, right? Third, the bills which remain overdue for a period of more than 90 days. The bills which actually remains overdue for a period of more than 90 days in case of bill purchase and discounting. Third, the installment of the principal or the interest which remain overdue for two crop season. The installment of the principal or the interest, it remains actually overdue for two crop season, or the installment of the principal which remains overdue for one crop season. So if we talk about the short duration crop is a crop which is actually less than 1 year, right? At long duration crop, it is actually more than 1 year. Long duration crop is actually more than 1 year. Okay. So if we talk about the installment or the principal amount, it remains overdue for two crop season. Two crop season, one crop season is harvesting plus plantation, right? So you have missed two complete crop season for a short duration crop. You have missed one complete crop season for a long duration crop. Then it is considered as what? Then it is considered as the non-performing asset. Okay. So non-performing asset, these are the points which you have to remember in a non-performing asset. Plus, what is out of order status? This is very important for all of you, right? What is out of order status? This you have to remember. Clear? If we talk about the formulas are related to what? Formulas related to non-performing assets. See, this is important. This can be asked in your examination, formulas, right? So first of all, if we talk about the gross advances is equals to as standard assets plus gross NPA, right? So gross advances is what? Standard asset plus the gross non-performing asset. It is known as gross advances. Gross NPA as a percentage of gross advances, it means that gross NPA divided by gross advances into 100%. So gross NPA divided by gross advances into what? Into 100%. Clear? Third, if we talk about the net advances is gross advances minus deduction. Okay, so net advances is equals to what? Net advances is equals to gross advances minus deduction, right? Net NPA, if we talk about the net NPA, it is gross NPA minus deduction, that is known as net NPA. Net NPA as a percentage of net advance. Now it is what? Net NPA as a percentage of net advances means net NPA divided by net advances into 100. So this is known as net NPA as a percentage of net advances. Clear? When we are talking about the asset classification, assets are classified into three parts. When we are talking about the asset classification, so assets are classified into three parts: substandard, doubtful, and loss asset. Assets are classified into three parts. There is a substandard asset, there is a doubtful assets, and there are loss assets, right? So substandard assets are what? When your amount is overdue for a period of more than 90 days, less than 1 year. Okay? From the date of repayment till the period of 90 days. If it is not paid, then it is non-performing asset, right? Now, if it exceeds 90 days, but it remains overdue for a period of 12 months, or you can say less than 12 months means 1 year, less than 1 year, then it is what? Then it is the standard, substandard assets, right? Now it remains overdue for a period of more than 12 months, right? More than 12 months. Then it is known as what? Then it is known as doubtful assets, right? Now it remains overdue for more than 12 months. It remains overdue for more than 12 months, then it is doubtful asset. Now, if the loss has been identified, means the bank now see that okay, there is something wrong, something default happened, right? And now the loss has been identified. Okay, then bank thinks that now it is uncollectible. Then that asset is actually termed to be as loss asset. Then is asset considered to be as what? Loss asset. Provisioning is done in the case of different type of asset. Now, what is provisioning? First of all, provisioning is bank actually set aside a certain percentage of their profit for what? A certain percentage of their profit for what? For the recovery of NPA. Okay, always a bank set aside certain percentage of their from their profit and loss, or from their profit, covered the non-performing asset. That is known as provisioning. And provisioning is done in the case of loss asset, substandard, and doubtful asset. And there are different percentage of provisioning that need to be done. If we talk about the loss asset, in the case of loss asset, 100% provisioning is to be done by the bank, right? Now, in the case of doubtful asset, doubtful asset, 100% provisioning is done when the realizable value is not enough to cover the advances. It means that bank has received some collateral, and if the counterparty default, bank actually sold that collateral in the market and recovered some value. That value is known as the realizable value. Now, for example, your debt is of 1 lakh, but realizable value is only 90,000, right? So you have 10,000 which is uncovered by the realizable value of that collateral. So in 10,000 you have to keep total 100% as in provisioning, right? Now, secured portion means this 90,000 you have to keep 25% from to 100%. So in this secured portion, there is a variation. You can keep from 25 to 100% as provisioning, right? So if we talk about the provisioning in 1 year, if up to 1 year, 25% provisioning is to be kept. From 1 to 3 years, 40% provisioning is to be done, and for more than 3 years, 100% provisioning is okay. Next, if we talk about the substandard asset, so in case of substandard asset, when the amount remains overdue for more than 90 days but less than 1 year, 15% general provisioning is done. Now, 15% is the general provisioning that you have to do. Okay, then 10% extra 10%, what extra 10% for the secured portion, which is total of 25%. Extra 10% for the unsecured portion, total of 25%, right? Infrastructure project, 20%, okay, and 20% provisioning is to be kept for infrastructure provisioning, right? Now, if there is an unsecured portion means which is not covered by the collateral, means collateral are not enough, which is not covered by the collateral, then it is known as unsecured exposure, right? So if we talk about the unsecured exposure, so in unsecured exposure, there is a doubtful asset. Now, in doubtful asset, 100% provisioning is to be done. Okay, standard assets, in the standard assets, 0.25 provisioning is done for farm credit, 1% provisioning is done for commercial real estate sectors, and 0.75% provisioning is done for commercial real estate, that is residential housing sectors. So these are the provisioning, right? Now, very important thing. If you are a large borrower, Okay. So if you are a large borrower, right? Large borrowers are who? Large borrowers are those where the aggregate exposure is over and above 5 crore. Okay, so if the aggregate exposure is over and above 5 crore, then they are known as the large borrower, right? So in case of large borrower, always remember bank has to send the reports to CAIIB, Central CAIIB, if you have an aggregate exposure of 5 crore and above. This report is sent on a monthly basis, and why this report has been sent, so as uh, the proper, there should be a proper guidance and there should be a proper monitoring on the accounts of the large borrower. There should be a proper monitoring on the accounts of the large borrower. Okay. Now, restructuring. What is restructuring? First of all, restructuring means it is an act in which a lender, for some economic and legal reason, due to the financial difficulty of the borrower, try to give some concession, known as what? Then it is known as a restructuring. So restructuring, what? Restructuring, for example, they involve modifications of terms of advances and securities, etc. Right? So restructuring is what? Restructuring is simple when in an act when a lender tries to give some concession, either they reduce the loan amount, or they reduce the payment period, or they reduce the amount of installment. So in some ways they try to give concession, okay, to the borrower due to the difficulty, financial difficulty of the borrower. Then it is known as what? Then it is known as restructuring. Okay, so restructuring, again, a very important thing. Last thing is the updated provisioning, which you have to learn, which is very important. Remember this updated provisioning. First of all, in case of substandard, which is a secured portion, if you have this NPA up to 6 months, then there is no change in the provisioning, means you have to maintain 15% provisioning. If it is from 6 months to 1 year, now the provisioning has been increased to 25. Okay, 25%. If it is a substandard up to 6 months, there is a 25% provisioning. From 6 to 1 year, there is a 40% provisioning. If there is a doubtful asset for the second year, you have to maintain 40% provisioning for the secured and 100% provisioning for unsecured portion. If it is in third or fourth year, you have to maintain 100% provisioning for both secured and unsecured portion. And if it's fifth year onwards, then obviously you have to maintain 100% provisioning for both secured and unsecured. Clear? So these are the revised provisioning which you have to learn. Okay, so these were the older one and these were the revised provisioning. Unit 29 of PPB Module B, that is important laws relating to recovery of dues. Okay, this is Unit 29, important laws relating to recovery of dues. Let's start discussing this chapter. Okay, first of all, if we talk about the first act, that is the Recovery of Debt and Bankruptcy Act 1993. So, Recovery of Debt and Bankruptcy Act 1993, this was enacted in 1993. First of all, this act was established or enacted in 1993. Okay, and it actually lead to the establishment of Debt Recovery Tribunal. DRT, Debt Recovery Tribunal, right? For the speedy debt recovery. If we talk about this DRP, this is amended in 2019. This act, sorry, this act has been amended in 2019, and then this act has been renamed as a Recovery of Debt and Bankruptcy Act. Okay, now what is the extent of this act? If we talk about the extent of this act, the act is applicable to whole India except the state of Jammu and Kashmir. So this act is actually applicable complete India except the state of Jammu and Kashmir. This act is applicable from 24th June 1993 through the DRT established progressively across the country. If we talk about the qualifying amount, cases where amount of debt due to any bank or financial institution is 20 lakh or more, which they are covered under this act. So if you as a bank you have any case in which the recovery amount or the amount due is 20 lakhs or more, then you are allowed, then your cases are handled by the Recovery of Debt and Bankruptcy Act. Okay. Now, if we talk about the establishment of tribunal, so in this, under this act, the most important thing which is established is the debt recovery tribunal. So central government is actually empowered to establish the debt recovery tribunal to exercise the jurisdiction and power and authority conferred or on under the DRT. Right. So there is a debt recovery tribunal which actually established in the Recovery of Debt and Bankruptcy Act 1993. If we talk about the presiding officer, yes, there is a presiding officer for DRT. There is a presiding officer which the appointment of the presiding officer should be, the qualification for the presiding officer is should be equivalent to the appointment of the district judge. So whoever the person is qualified for the appointment as the PO in DRT should have the same qualification which needed to be appointed as a district judge. Now what is the tenure for holding the office of presiding officer? So the tenure is the presiding officer hold the office for a term of 5 years. So presiding officer, they hold the office for a term of 5 years or until they achieve the maturity of 65 years, whichever earlier, right? So either they hold the office for a period of 5 years or till the age of 65 years, whichever is earlier. Okay. Now there are some staff of tribunals also. Okay, now staff of tribunal, if we talk about the staff of tribunal, the tribunal is provided with one or more recovery staff. And these are the staff which work under the superintendency of the presiding officer, which actually works under what? Which actually work under the superintendency of the presiding officer. Everyone, okay, clear? That so there is the presiding officer and there are the recovery officers which work under the presiding officer. Okay, done everyone. Okay, now next thing. Next is the chairperson. So DRP. So for this DRT, Debt Recovery Tribunal, there is a chairperson also. So there is a presiding officer, and the qualification for the presiding officer should be equivalent to the appointment of the district judge, right? There is a chairperson. Now, chairperson, a person who is qualified for the appointment as a chairperson, they should be qualified to be a judge of high court. They should be qualified for what? They should be qualified to be the judge of high court. Right. If we talk about the chairperson hold the office for a term of 5 years or until they attains the age of 70 years, whichever is earlier. So until the age of 70 years or the 5 years term, whichever is earlier. So the chairperson of the DRAT enjoys the power of superintendence and the control over the tribunal. Now, if we talk about the DRT, Debt Recovery Tribunal, if we talk about DRT, means the Debt Recovery Tribunal. A tribunal has the jurisdiction, power, and authority to entertain and decide. So here DRT is what? DRT means a tribunal has the jurisdiction, power, authority to entertain and decide what? First of all, application from the banks and financial institution for the recovery of debt. And second, application which is under the part third of Insolvency and Bankruptcy Code 2016. Now there are DRAT, Debt Recovery appellate tribunal. Now, appellate tribunal is what has the jurisdiction, power, authority to entertain appeal against any order made or deemed to be made by a DRT. So, if you are not satisfied with any of the order that has been given by DRT, you can go to DRAT. DRAT is what a debt recovery appellate tribunal. Now, you can file an appeal against DRT's order to DRAT. But whatever the decision DRAT is giving to you, this decision is actually final. Whatever the decision DRAT is giving to you, this is actually final. You cannot file an appeal against the decision of DRAT. This is the finalized decision, right? You have to accept it. Next, if we talk about the bar of jurisdiction of civil courts, okay, so subsequent to the establishment of DRT, no civil court or authority has any jurisdiction, power, or authority to deal with the recovery cases of rupees 20 lakhs and above. Okay, so because if you have a case of rupees 20 lakhs and above, you have to recover this amount, then case is actually resolved by the debt recovery tribunal. Your case is actually resolved by who? Your case is actually resolved by the debt recovery tribunal. Okay. Now, if we talk about the debt recovery tribunal, so besides the debt recovery tribunal, there are no civil courts who are allowed to handle the cases of rupees 20 lakhs and above. Now, what are the time limits for the disposal of the application of DRT? So the time limit is 180 days. Okay, so if you have a application received by the debt recovery tribunal, the time limit for the completion of this DRT is 180 days. Now, appeal to the appellate authority. If you are not satisfied with DRT, then what to do? You can go to DRT, right? Now, they have also the time limit, right? They have also the time limit to deal with the cases. So, what are the time limit to appellate authority? So, if there is any person who is aggrieved by the order of tribunal, okay, or deemed to be have passed by the tribunal, you are aggrieved by the order of tribunal, you do what? So within 30 days from the date on which the copy has been received, okay, you must file an appeal to an appellate authority within 30 days of receiving the order from the uh, uh, appellate tribunal, right? Now, if we talk about the appellate tribunal, after hearing both the parties, passes order either confirming, modifying, or setting aside the tribunal order. Okay, so appellate tribunal does what? After hearing both the parties, passes order either confirming or modifying or setting aside the tribunal order. Now, appellate authority shall attempt the appeal is disposed of finally within 6 months from the date of receipt. So, appellate authority shall attempt that the appeal is disposed finally within 6 months of the date from the date of the receipt. Clear? Now, next, if we talk about the SURFACE Act, next act is the SURFACE Act. SURFACE Act is securitization and asset reconstruction. The two most important things under the SURFACE Act is the securitization and reconstruction of the financial asset. Okay. Now, SURFACE Act empowers the bank and financial institution that they can sell the securities in the case of default by the borrower without the intervention of any court. So, you has been given, bank has been now relieved and got a good relief under the SURFACE Act, because if we talk about the early days, bank were not willing to accept land and building or any immovable property as a collateral. Why? Because there were a lot of challenges. When the borrower default, there were a lot of challenges that were faced by the bank for the recovery of the debt. Okay, so the under the SARFAESI Act, the bank has been now given freedom that you can just do what you can just uh, sell the immovable property, you can just enforce the immovable property in the case of the default by the borrower. So, in the case the borrower's default, you can sell the immovable properties, and that too without the intervention of the civil code. Now, if we talk about the extent, SARFAESI Act is actually extended to complete India, including the state of Jammu and Kashmir, Union Territory of Jammu and Kashmir. Now, what is the qualifying amount? So, this act is applicable to all those cases where the principal amount is due and it is more than 1 lakh. Where the amount which is due, principal amount which is due, is 1 lakh or more. Plus, there is another condition also if your principal amount is anything, but the amount due is more than 20%. Okay, for example, you have the principal of amount of 100, only 20 rupees is given, but 80 rupees is still overdue. Now, this case can be handled by SARFAESI. Okay, exclusion, SARFAESI Act is not applicable to the agricultural land. Okay, always remember SARFAESI Act is not applicable to what? SARFAESI Act is not applicable to the agriculture land. Okay, next, if we talk about the next thing, SARFAESI Act 2002, enforcement of the securities interest. So, if the borrower defaults, what is the process of that? If the borrower defaults, see, when borrower default, you have to give a proper time and notice to the borrower who is defaulting on the payment, and you have to disclose the NPA liability, and you have to disclose it within 60 days. Now, there is a 60 days time period which has been given to the borrower under SARFAESI Act, that you have to submit the money within the 60 days. Okay, if the borrower has any objection and of this notice, you can respond it, counter it within 15 days, right? Now, if you haven't followed this, you have missed this 60 days time period, you still don't pay anything, right? Now, bank has all the right to sell your securities and recover the loan from. Now, whatever realizable value is means whatever the money that is recovered from selling of the securities have three purposes. First of all, this money has been utilized towards any cost, charges, and expenses that are towards the protection of securities and insurance premium, which are recoverable by the borrower. Second, if we talk about the second thing, this actually dues towards the secured creditor. Secondly, first, any cost if you have incurred for the preservation of the securities, right? You have to settle down this first. Secondly, you have to settle down the main amount secured the creditors. You have to settle down the main amount. Now, if any surplus is left, now still if there is any surplus which is left, now you have to return it back to the borrower. Okay, so if there is any surplus, it is paid to the person entitled in accordance with the right and interest. Last, if we talk about the SARFAESI, under SARFAESI, there has been a central registry that has been established by the central government, and this central registry is for what? This central registry is for securitization, reconstruction of the financial asset, and creation of securities interest under the SARFAESI Act. If we talk about the central registry functions, under the superintendence and direction of the central registrar, appointed by the central government, the Central Registry of Securitization and Asset Reconstruction and Securities Interest of India (CERSAI) become operational on 31st March 2011. Okay, so CERSAI, Central Registry of Securitization and Asset Reconstruction and Securities Interest of India, this become operational. Okay, CERSAI, March 31, 2020. 211. Okay. Last, there is a law of limitation. If we talk about the law of limitation, first of all, Law of limitation passed in 1963, and law of limitation defines a period of limitation. Period of limitation means that there is a proper time period, there is a limit, there is a maximum time period in which counterparty can take legal action against the defaulter party, right? For example, A has lent money to B, right? And B default in this case. Period of limitations means now A is the creditor. A has the right to file a legal application against the defaulting party. This legal application should be filed within 3 years of receiving the application of defaulting. Okay, so if he defaults today, then there is a time period of 3 years. Okay, so within 3 years, A has to file an appeal or legal application against the defaulter party, right? Now, if this miss out, okay, if this applications miss out, then what? Then the period of limitations is, if the period of limitation is over, then you don't have any right to file an appeal against. This is known as the period of limitation. Clear? Now, if we talk about the period of limitation, there are different period of limitation defined. First of all, for money payable towards the money lent, there are 3 years time period which are being given. For the agreement, bill of exchange, promissory note, there are 3 years period of limitation which has been given, right? For rent area, 3 years. For the performance, specific performance of a contract, 3 year period of limitation. For mortgage, 30 years. Okay, immovable property, 12 years. For possession of immovable property, 12 years period of limitation is given. So this period of limitation is very important. So if you want to file a legal application against the defaulting party, if you want to file a legal application against the defaulting party, you have to follow this period of limitation. Clear? Clear? Going to discuss about what? Today we are going to discuss about Unit 30 of PPB Module B, that is contract of indemnity. So we are going to discuss completely about what is contract of indemnity, how it is dealt, right? So contract of indemnity, this is Unit 30, okay, PPB Module B. So let's start discussing this topic, okay? The very first thing is, what is the contract of indemnity? How this contract of indemnity is actually defined. Okay, so section 124 of Indian Contract Act 1872 defines contract of indemnity as a contract by which one party promises, a contract in which one party promises to save the other from the loss caused to him by the conduct of the promisor himself or by the conduct of any other person, is called as the contract of indemnity, right? Contract of indemnity is what? For example, there is a one company, right? And there is one person. Okay, so this company promises to this person that if you occur or if you suffer any losses, okay, your losses, if you suffer any loss from any third party, okay, your losses will be indemnified. Your losses will be covered up or compensated by this company. So this is known as the contract of indemnity. I mean, there can be a company also, here can be a person also, where one promises, one party, you just use this word party, where one party promises to another party that if you suffered any loss from any third party, this loss will be covered up by me. This loss will be covered up by me. Then it is known as what? Then it is known as the contract of indemnity, right? The person who giving the promise is called as indemnifier. So here, this company is called as indemnifier. This company is what? Indemnifier. And the person to whom the thing is given or to whom the promise is given is called as indemnified or indemnity holder. Indemnified or indemnity holder. Clear? Now, we talk about the examples of the contract of indemnity, so all the insurance contract are the contract of indemnity. Why? Because see, in an insurance company, for example, I have bought some insurance, five insurance from the company, right? So in this, the company is actually doing what? The company is actually telling me that if you suffered any loss from the fire, then your loss will be indemnified or your loss will be covered by this company. So this is known as the contract of indemnity. So all type of insurance contract are the contract of indemnity. And always remember, the essence of any contract of indemnity is you must prove a loss. First, you have to prove a loss that, okay, I have suffered this loss. First, you have to prove that, okay, I have suffered this loss. Okay, when you have proved that, okay, you have suffered this law, then your loss will be what? Your loss will be indemnified by the indemnifier. So there is the indemnifier, there is the indemnified or indemnity holder. Clear? Now, next, if we talk about the next thing, what are the difference between the indemnity contract and the guarantee contract? So there is a contract of guarantee. Guarantee means where the bank is giving promise or where the any third party is giving promise on the behalf of the principal debtor that if debtor defaults, then the money will be covered by the guarantor, right? But there's a difference between the indemnity contract and the guarantor contract. First of all, if the number of parties is concerned, so in the contract of indemnity, there are only two parties. In the contract of indemnity, there are only parties, and the two parties is first who is making the promise, indemnifier, and second, to whom the promise is made, means the indemnified person, right? But if we talk about the contract of guarantee, in contract of guarantee, there are three parties. Now, what are these three parties? There is one principal debtor, okay, on whose behalf the guarantee is given. There is one creditor, okay, the beneficiary of the guarantee, right? And there is one person who is suring or who give the guarantee, which is known as the surety, okay. So, there are three parties in the contract of guarantee, whereas in the contract of indemnity, there are only two parties. Okay. Second, if we talk about the contingent risk, so in indemnity, the risk is contingent. Okay. If we talk about the indemnity, the risk is actually contingent, whereas in the guarantee, the liability is subsisting. What is contingent risk? First of all, if we talk about the contingent risk, that contract of indemnity, the indemnifier, the one who is making you the promise that I will make good of all the losses that you have occurred, right? So the indemnifier's liability only arises when the specified event or loss incurred. Okay, until the triggers happen, there is no liability of indemnifier, right? So indemnifier's liability will only arise when the event occurs. Until then, there is no liability of indemnifier. That is known as contingent. Okay. Whereas, if we talk about the subsisting guarantee, the liability of the surety is subsisting. It means that guarantor's liability exists as long as the debtors fails to meet their obligation. So the guarantor's responsibility is to actually step in and fulfill the obligation if the debtors default, right? For example, this bank who acquire a personal loan from the individual, right? Okay, or there is a bank who requires a personal guarantee for an individual for the loan taking for a business. Now, in this, business defaults on the loan, the individual guarantor must have to pay the loan. Okay, so the guarantor's liability is active as long as the principal debtor's liability is active. Okay, and as long as the debtors does not repay the loan. Okay, whereas in contingent, only and only when if the event occurs, then only the case will arise, and then only the liability will arise. That is known as contingent. So in indemnity, the risk is contingent. Whereas in the guarantee, the liability is actually what? The liability is actually subsisting. Okay. Next, if we talk about the nature of liability. Now, if we talk about what? If we talk about the nature of liability. So, in a contract of indemnity, the indemnifiers is required to make good the loss as soon as it occurs. Okay, and he cannot rely on the fact that any other person on whose behalf the indemnity is given has to make the good the loss. Okay, for example, if A occurred with some accident, as soon as this accident occurred, the indemnifier, the company which provide the insurance, accidental insurance, they have to step in and they have to cover the losses to the A, right? They cannot rely on the fact that the person on whose behalf the indemnity has given has to step in and make good the loss. No. Whereas in the guarantee, the surety's liability is actually secondary. Here, the surety liability is secondary. When principal debtor defaults, then only the surety liabilities come, right? So in indemnity fire contract or indemnity contract, whoever is promising you that he will make good the loss, right? They have to step in as soon as the event occurs, right? Means the liability of the indemnifier is actually primary. Whereas if we talk about the nature of the liability in the case of what? In the case of guarantee, here the surety liability is secondary and the principal debtor's liability is or primary. Okay. Sorry. Next, number of contracts. So there are only two contracts in the contract of indemnity. Okay. Or you can say there is only two parties in the contract of indemnity and there is only one contract. Whereas in contract of guarantee, there are at least three contracts. One contract is with the debtor and the creditor. The other is with the creditor and the surety. And the third is between the surety and the debtor. Clear? Purpose of the contract, if we talk about the purpose of the contract, an indemnity is for reimbursement of a loss, okay, whereas a guarantee is for the security. Here it is the reimbursement of the loss, but here it is the security of the creditor, right? If we talk about the indemnity contract and guarantee, it can be express or it can be implied. It can be express or it can be implied. It means that if you talk about the contract of indemnity, it may be in written, it may be given in written, they can be expressed, or it is implied as per that situation, right? So this is the difference between contract, indemnity contract and the guarantee contract. Clear? What is the implied indemnity? So implied indemnity, if I've just give you an example of implied indemnity. What is an implied indemnity? So suppose an example. Okay, imagine there is a person A who is a contractor. Okay, and who, oh, sorry, just give me 1 minute. Okay, sorry. So I've just given you example. I'm just telling you that, for example, there is a person A who is specialized in a innovation, okay, renovation thing, okay. Now there is a client B, okay, who requests A install a new fence on his property. Okay. Now that person A install the fence according to the person B's or her client's specification. At the time of installation, person A follows all the direction of his client, does not recognize any of the issues with the fence designs or anything. Right? Now, after the installation, it's turned out that that fence, because of the placement, obstruct a public sidewalk. Now, this obstruction lead to a pedestrian. There was a pedestrian which was going from that sidewalk, okay, and her name was C, for example, okay. But she was being injured when there was a trip over the fence. Okay. Now Sarah is held liable for the injury to Jamie because Sarah has installed that fence. Okay. So A is actually held liable for the injury to the person C. Okay. Now, although Sarah is actually responsible for building that fence, is that's why person C just go to person A that you have to indemnify my loss. Okay. But now, if we talk about here that person A follows the complete order of B, now here there is an implied indemnity which arises of B. That B have to cover the loss of A. B have to cover the loss of A. Why? Because A has followed all the order of B. So there is an A person, helpline was B, and there was C person, right? So always remember when C fell from that fence, okay, so C demanded the loss compensation from A because A has built that fence. But here now A has given that you can say compensation to C. It is good, but because A has completely follows the order of B, so B there is an implied indemnity that B has to indemnify the loss of A. There is an implied indemnity that B has to indemnify the loss of A. Clear? So this is known as implied indemnity, and this is according to section 124 of the Indian Contract Act. Okay. Now, the last thing is scope and application of indemnity or contracts to the bank. If we talk about the scopes and application, in case of the bank, how the indemnity and indemnifier exists. So, for example, customer has lost a demand draft or a traveler check. They are required and they are just going to a bank and asking that please issue a fresh demand draft to me. Now in this case, before issuing a fresh demand draft, the bank always make the customer sign in the contract of indemnity. Says that if that original demand draft was found by someone else and they actually misuses that demand draft and bank suffered loss because of that demand draft, then that loss will be recovered by the customer. Now the customer has to give this promise the bank that if that original demand draft was found by someone else and they actually misuses it and bank suffered the loss, then I will indemnify the loss. So the one who is making promise, customer, is the indemnifier here. Customer is what? Customer is the indemnifier here. Okay, and bank is indemnified, and the contract is the contract of indemnity, and the contract is the contract of indemnity. Clear? Okay, now let's start with some of the practice questions. Okay, the first person promising to save another from the loss is called as person promising to save another from the loss is called as indemnified, indemnifier, collecting banker, or the paying banker. You can all answer this question, everyone. Please answer this question, guys. A person promising to save another person from the loss is called as. Everyone, please answer this question. So, the person who is promising to save the another person is called as indemnifier. So, D is the correct answer. Okay, next. There are parties. How many parties to a contract of indemnity? How many parties to a contract of indemnity? Everyone. There are how many parties to a contract of indemnity? Everyone, please answer this question. There are how many parties to a contract of indemnity? So if we talk about the contract of indemnity, there are two parties in the contract of indemnity, right? Next, indemnifier's liability in the contract of indemnity is primary, secondary, collateral, or discretionary. I've already discussed you, so the indemnifier liability is liability. Going to discuss Unit 31, that is contract of guarantee and bank guarantee. So we are going to discuss about the contract of guarantee and bank guarantee. This is PPB Module B and Unit 31. Okay, so let's start discussing this topic. Okay, so the very first thing, if we talk about the guarantee, guarantee is what? It is a contract to promise, or discharge the liability of a third person in the case of later default. A guarantee can be a written or the or the oral, right? So guarantee is what? Guarantee means, for example, I am giving you the example of what is guarantee. For example, there is a person A and there is a person B. A lends money to B or loan to B. Now B has to repay back this amount because this amount is very big. So this amount is very substantial. So A want a guarantee also from B side. So B's friend C, for example, there is a friend C. C guarantees or give a surety to A that if B defaults on repayment, if B defaults on a repayment, then the payment will be done by C. The payment will be done by C. Then it is known as the contract of guarantee. Now, remember, here A is giving money to B. So, A is what? A is the lender, or you can say A, it is a creditor. Okay. Then B is the principal debtor, the one who has to pay the money. And C, because he gives surety, right? He gives guarantee for the payment, and so C is the surety, right? This contract of guarantee, the contract between them, it is known as the contract of guarantee, and this can be oral as well as the written, right? If we talk about the person who gives the guarantee, the person who gives the guarantee is called as the surety. The person in respect of whose default the guarantee is given is called as the principal debtor, and the money who is which is given, or whom the guarantee is given, is called credit or beneficiary. Section 128 of the Indian Contract Act 1872 says that the liability of the guarantor is co-extensive with the principal debtor. It means that what, for example, if we talk about the liability of the debtor, so for example, the debtor, the amount due is, for example, 1 lakh. So the complete liability is of surety. You can say that the guarantor is equally responsible for covering the debt. In case of principal default, the guarantor will equally be responsible for covering the debt. And that's why they are saying that the contract, the guarantee is actually co-extensive with the principal debtor. Okay. Next, if we talk about the essence of guarantee, the essence of guarantee is that the guarantee agrees to discharge his liability in the case of happening of one event when the principal fails to perform in his or her duty. Okay. Next, if we talk about the continuing guarantee, so what is a continuing guarantee? A guarantee which is extended to a series of transaction. A guarantee which is extended to a series of transaction, that is known as continue guarantee. Okay. For example, there is Mr. A who contract with Mr. B, who is a shopkeeper, allow Mrs. A to take whatever goods she may need from his shop. Okay. And it can be up to the amount of rupees 20,000. And Mr. A will be liable for the debt incurred by Mrs. A up to the given amount. That is known as the continuing guarantee. Okay. So continuing guarantee here, Mr. A contract with B that you have a continuing guarantee in respect of Mrs. A, that she is allowed to take whatever goods from his or her, from the shopkeeper's shop, to the amount of 20,000, and Mr. A will be liable for paying the debt of Mrs. A to the given amount. Then it is known as the continuing guarantee, right? If we talk about the continuing guarantee may be revoked at any time. by the surety for the future transaction by noticing the creditor, right? This is as per the section 130. So if, for example, Mr. A want to revoke the guarantee, Mr. A can revoke the guarantee given to shopkeeper anytime by giving a notice to the creditor. Normally, if we talk about the in case where automatically the continuing guarantee ends, first of all, if it is the case of death. Okay, so normally when the surety dies, the guarantee ends from that date. However, it is not true in all cases. It depends upon the contract and the intention of party as regard to the future transaction. The death of the surety operates in the absence of any contract to the contrary, act as a revocation of the continuing guarantee so as future transactions are excellent. Okay, next. Variance in terms of a contract. So if there is any changes, if there is any variance, if there is any changes, modification that is done without informing the surety, without the consent of the guarantor in terms and condition of a contract guaranteed by him. Now, this is actually between the principal debtor and creditor. Now, this discharges the sureties because the surety has no information about the changes. And this is according to section 133 of Indian Contract Act. It says that, for example, there is a principal debtor and creditor who just changes the terms of the contract without informing or without any consent of the surety. Now, this terms and condition, this modification or changes in the term and condition will discharge surety from his or her liability. Why? Because the surety don't have the knowledge about that modification, plus they don't give the consent to that modification and changes, right? If we talk about the discharge of the principal debtor, the discharge of the principal debtor, if the creditor and the principal debtor agrees to a new contract. So if there is a creditor and if there is a principal debtor and they agrees to a new contract, and from this new contract it actually releases the principal debtor from the original obligation, the surety will also be discharged from their guarantee. So if there is any new contract between the creditor and debtor which actually releases the debtor from his liability, the same will be applicable to surety. Surety is also discharged from their guarantee. This is because the original contract, which was the basis of surety application, has been modified or cancelled. If the creditor takes some action or fails to act in a way that legally release the principal debtor from the obligation, the surety is also released. This is according to section 134. Okay, now security. The surety is entitled to the benefit of every security which the creditor has against the principal debtor at the time of the contract. It means that, for example, there was a contract between the creditor and the debtor, and the debtor has kept some collateral to the creditor, right? Now, in case of default, the creditor has actually sold some collateral in the market and recovered some of the amount. Okay, for example, the amount due was 1 lakh. The creditor has sold the collateral worth rupees 50,000 in the market and recovered 50,000. So now only 50,000 is left. So the same is applicable to the surety also. Surety is not responsible for the complete 1 lakh amount because from this 1 lakh, 50,000 is recovered by the selling of the collateral, and this will be applicable to the surety also. Now, the surety is only responsible for repaying the rest of the money, that is 50,000. Clear? Implied promise by the principal debtor to indemnify the surety. So, this is the implied promise. Okay, for example, A has given loan to B and B has to repay back this loan to A. But on behalf of B, his friend C has given guarantee to A that in case of B default, I will be repaying back your money. Now B defaults. Now the circumstances come where the B defaults on the loan. When B defaults on the loan, C has to repay the loan to A. Now it is the implied promise already understood that This money which C has repaid to A, it is actually covered from B. B has to give this money to C in the future. Then it is the implied promise. So there is an implied promise by the principal debtor to the surety. In every contract of guarantee, this is an implied promise. Implied means already understood. You don't have to specifically mention it, right? Implied promise by the principal debtor to indemnify, to make good the loss of the surety. The surety is entitled to cover the amount of from the principal debtor for whatever the sum he has paid under the guarantee. Clear? And this is section 145. Sections are important. Again, I'm saying sections are important. This is section 145. Okay. Now, next, co-sureties for the same. If we talk about the co-sureties from the same debt, when two or more person are co-sureties for the same debt or duty, either jointly or severally, and whether under the same or different contract, or whether with or without the knowledge of each other, show surety in the absence of any contract to the contrary, are liable as between themselves to pay an equal share of the whole debt, as a part of which remain unpaid by the principal debtor. It means that, for example, there is a one amount, okay, and on behalf of this amount, there are four guarantor A, B, C, and D. There are four guarantors, okay, and the four guarantors are equally responsible for paying this. Okay. Now, in case of default, whatever money is left from for repayment of this amount, this can be recovered in the equal portion from all the four guarantors, right? So all the guarantors should have to contribute equally for the repayment of the loan to which they provide the guarantee. Okay, clear? So always remember that the co-sureties, there can be one or more guarantor for the same amount. And if there is more guarantor for the same amount, and if defaults happen, then the lender can recover, then hold liable all the guarantors for the amount, and they can just contribute equally or equal portion of amount for the recovery of that debt, right? Now, if there is a release of one surety, they cannot discharge other from the duty. For example, uh, due to the circumstances, due to any circumstances, I am the creditor and I just discharges A from their liability. Okay, there are four guarantor on behalf of me, or for example, for the lender, the four guarantors give uh, guarantee to me, right? So if I discharge any one of the guarantor, for example, I discharge A, I discharge any one of the guarantor, I discharge A. It doesn't means that B, C, and D also discharge from their liability. No, they are equally responsible for the debt. Okay, so if there is a release of any one surety, it doesn't mean that all the sureties are released from the responsibility. Clear? Now, if we talk about the bank guarantee, so bank guarantee can be of three types. Bank guarantee can be of three types. It can be a financial guarantee, it can be a performance guarantee, and it can be a deferred payment guarantee. Financial, performance, and a deferred payment guarantee. So, if we talk about the financial guarantee, very simple. A has given loan to B and B is responsible for repayment. Now, on behalf of B, C has given surety or guarantee to A that if B fails on repayment, I will be paying the money. Then it is a financial guarantee. Very simple. There is a performance guarantee. Performance guarantee means if you are not following the performance, or if you are not fulfilling the performance, then you are held liable for the loss. For example, there is an international buyer which is PQR Limited. Okay, or for example, I'm just giving you an example of performance guarantee. For example, there is an XYZ Limited who is actually contacted for the construction of a building of a bridge. Now, there is a client ABC which requires XYZ to provide a performance guarantee of 50 lakh rupees from a particular bank. It means that if XYZ is unable to build a bridge within the specified time period which is mentioned in a contract, then on behalf of this XYZ, bank will be responsible for compensating ABC rupees 50 lakh for any of the loss incurred. Okay, that is known as the performance guarantee. That is known as the performance guarantee. And deferred payment guarantee, first of all, what is a deferred payment? What is meant by a deferred payment? Deferred payment means when the money is not paid immediately, the whole amount is not paid immediately. Instead of the immediate payment, it is actually distributed into the monthly installment, which is fixed for a particular period of time. Like, for example, there is an international buyer, PQR Limited, who agrees to purchase our money from a supplier and the payment is deferred over 6 months. The money is distributed into a equal installment in 6 months. Now the supplier, they want a deferred payment guarantee in which the bank of the PQR Limited assures the supplier that in case of default of any of the EMIs or the payment, bank will be responsible for paying the supplier. This is known as the deferred payment guarantee. Clear? The last thing is when you are issuing a bank guarantee as a banker, when you are issuing a bank guarantee, for example, the bank guarantee is very simple. For example, A lent loans to B and B is responsible for repayment, but on behalf of B, the guarantee is provided by the bank that in case of default of B, I will be responsible for paying the amount to you. Then it is known as bank guarantee. Now, when you are providing a bank guarantee, some of the important points you need to take care before giving a bank guarantee. First of all, you need to ensure that what is the amount that is involved in that guarantee. The very first and the most important thing is what are the amount that is involved in the bank guarantee. Second, what is the period of guarantee? Okay, for which time period the guarantee is valid. Then how to claim the period in a guarantee. Be legal aware of the legal amendments, and then what are the counter duty and other securities which the debtor is providing to the banker, right? So these are all the points which you need to take as a precautionary step while issuing the bank guarantee. Going to discuss about letter of credit. Okay, so this is letter of credit, the unit 20, unit 32 of PPB module B. Let's start discussing this topic. First of all, what is a letter of credit? A very general consideration about the letter of credit. A letter of credit can be compared to a guarantee. What is letter of credit? Letter of credit is actually considered as a guarantee given by bank on behalf of its customer, right? That the bank would make payment to the beneficiary when the beneficiary present the document as in the letter of credit. Okay, so letter of credit is actually like a guarantee. Okay, this is like a guarantee which is given by the bank on the behalf of the customer, that if everything is as per the documentation that is present in the letter of credit, if everything as per the requirement that is present in the letter of credit, the bank will be responsible for making payment to the beneficiary in the letter of credit. Now, what is the difference between this guarantee which is given on the letter of credit and bank guarantees? Basically, letter of credit is regarding the export or import, right? When there is an export and import, when there is a buying and selling, okay, between two different countries where the buyer and sellers, they oftenly don't much engage themselves into the transaction, okay? So to ensure the payment, to ensure the better trade between the export and import, letter of credit is issued as a guarantee given by the customer that Everything, if everything is as per the satisfaction and as per the documentation which is provided in the letter of credit, the beneficiary will get the payment. Now it is actually a non-negotiable instrument, means you cannot forward this letter of credit, you cannot endorse this letter of credit to anyone else. Okay, now what is actually the letter of credit, how this letter of credit things work. If we talk about the letter of credit, how the letter of credit works, okay, first of all, it's a very simple criteria about the letter of credit. Now how the letter of credit works, first of all, imagine you are a company, right? You are a US company and your name is ABC Electronics Limited and you want to buy 1,000 smartphones from China. Okay. So you are actually what? You are ABC Limited. Okay. You are what? You are buyer. Okay, I'm just telling you the example. ABC Limited, you are a buyer and you are a US based company, right? And you want to import, okay, some 1,000 smartphones from the exporter. Okay, now, exporter, for example, let's say it is XYZ Limited, and this exporter is in China, right? So this is the seller, okay, and you are the buyer. So ABC Limited is a importer buyer, and importer want to import some 1,000 smartphones from a manufacturing unit, that is XYZ Electronics Limited, and that is from China. Now, this ABC Limited and XYZ Electronics agrees on some terms and condition of the sale. And XYZ ensures that you will be paying, that ABC Limited will be paying the smartphones for the smartphone before the shipping, right? So actually, because XYZ Limited and ABC Electronics, these don't often engage themselves in the transaction. One is US based and second one is China based, right? So now they agreed some terms and condition of sales, and the exporter, that is the XYZ Limited, they want to ensure that the payment should be made before the shipping the transaction. And to give XYZ confidence, okay, ABC Limited goes to bank. For example, you can say ABC Limited, this is the US bank, okay, or you can say your bank. This is actually the your bank in the importer's country is your bank, and this is the China bank, right? Here it is the exporter bank, which is the China bank. Now, to give XYZ Limited the confidence that you will be get paid, okay, don't worry. So, actually, this ABC Limited goes to your bank, which is actually what? Which is actually the bank in the importer's country, and ask them to issue a letter of credit. Okay, and you will need to provide this ABC Limited needs to provide all the details about the transaction, like what should be the terms and condition of the sale, what should be the amount of the sale, everything, right? Now, if this your bank is satisfied, okay, then your bank issue the letter of credit and send it to Bank of China. So this your bank, this issues the LOC, letter of credit, and this letter of credit is sent to China Bank. This is letter of credit is sent to China Bank, and this says that if XYZ Electronics meet all the conditions that are given in the letter of credit, then your bank will guarantee the payment to this China bank. So this your bank issues letter of credit on behalf of this ABC Limited, ensuring the China bank that if XYZ Limited executed the transaction as per the satisfaction, as per the details which are outlined in the letter of credit, then XYZ on the behalf of ABC Limited, your bank will be paying to China Bank a particular payment, right? Now, XYZ ship the smartphones and provide the necessary document like shipping receipt and invoices to China Bank as a proof of shipment. Now, XYZ, they ships the phone. They ships the phone, right? Now, after shipping the phone, this XYZ provide the necessary document to China Bank as a proof that they have shipped the phone, right? Now, China Bank reviews every document to ensure that everything matches as per the letter of credit contract. Okay. Now, once confirm, once China Bank is satisfied that yes, everything is as per the letter of credit, China Bank sent this proof, okay, to what? To your bank. So China Bank sends what? Information and documents to your bank. Clear? Now, your bank again verifies all the document. Okay, and if satisfied, your bank makes payment to China Bank. Your bank makes what? Payment to China Bank. Once China Bank has received the payment, China Bank pays it to XYZ Limited, right? Now, after you receive the payment, after this A by ABC Limited receive the delivery of the particular 1,000 phones, okay, then this ABC Limited pays to your bank particular sum of money which is specified in the letter of credit. So this is actually the letter of credit. Very simple thing. There are two one. So there is import and export, right? So XYZ Limited and ABC Limited, these are two companies. One is a US based and one is China based. And importer want to import 1,000 phones from XYZ Limited. Now to ensure the payment, okay, to give confidence to XYZ, ABC Limited comes to your bank. Your bank is a bank in the importer company and ask them to issue a letter of credit, and they present all the necessary documents relating to the trade, right? Now your bank issues the letter of credit and send it to China Bank, and this letter of credit says that if everything is as per the letter of credit outlined in the letter of credit, okay, after executing the trade, your bank will be responsible for paying China Bank this particular sum of money which is stated in the letter of credit and send it to China Bank. China Bank reviews the letter of credit and send it to XYZ Limited. Now, XYZ Limited ships the 1,000 smartphones to ABC Limited. After shipping, they present all the necessary document as a proof of shipping to China Bank. China Bank once reviews the document if satisfied that yes, everything is done as per the condition specified in the letter of credit, send it to your bank. Okay. After your bank reviews all the document, your bank is satisfied with the letter of credit, your bank is satisfied with the transaction, your bank sent payment to China Bank, and after receiving China Bank payment, China Bank sent it to XYZ Limited. Lastly, as a buyer, ABC Limited, when ABC Limited received the delivery of 1,000 smartphone, after receiving the delivery, ABC Limited pay to your bank. The complete thing is executed. This is known as what? This is known as the letter of credit. This is known as what? Letter of credit. Clear, everyone, what is letter of credit? Everyone, just please tell me. Everyone, it's a request that please like and share the video to the maximum you can. Everyone who is watching this session. Now, in this letter of credit, there are different parties, like there is applicant, buyer, importer, or opener. So, importer, buyer, which is also known as opener of the letter of credit. There is a issuing bank. The bank which is in the importer's country, this is the issuing bank. There is a beneficiary, means exporter, who is to receive the payment. There is advising bank, which is the notifying bank. The bank in the exporter's country is actually the notifying bank, right? There is a negotiating bank, the bank in the beneficiary or exporter country which negotiate the bill. Okay, sometimes that exporter, for example, need immediate payment, so this exporter goes to a bank that actually negotiates the bill, make the payment for the bill and accept the document. This is the negotiating bank, and this is present in the exporter's country. There is a confirming bank. The advising bank is only required to advise the credit to the beneficiary. Now, if the seller is not conversant, now sometimes the seller is not satisfied with the issuing bank or the financial position of the issuing bank, he actually adds some additional guarantee from any other bank located in his country, that for confirm the letter of credit. It is not in every case, it is in some case. Now, reimbursing bank, so it is a bank which is appointed by the issuing bank to make the reimbursement to the negotiating author, paying or confirming bank. So this is not compulsory that there is uh, uh, in every situation. This is not compulsory that this is in every situation. This is not compulsory that this is in every situation. These four are compulsory in every situation. These are the add-on. This is the for adding the security. This is for reimbursing. Okay, sometimes there's a bank which is appointed by the issuing bank to reimburse the negotiating, paying, or the confirming bank. Okay, so that is the reimbursing bank. Okay. Now, what are the advantages and disadvantages to the buyer and seller of the letter of credit? First of all, for the buyer, it is a good advantage that the letter of credit gives you, or the letter of credit gives you that you don't have to make any advance payment. Okay, it actually induces the seller to give the credit in the view of guarantee. It actually puts a condition for providing a certificate, right? The seller is assured of receiving the payment. First of all, the main thing is this letter of credit is acting as a guarantee, okay, that you will receive the payment. Okay, on shipment of good, seller can draw bill and get them negotiated with the bank if in their country, getting immediate payment. Okay, so these are the different advantages this which is provided to the buyer and seller. Clear? Now let's if we talk about the types of letter of credit, so there are different types of the letter of credit. Now, what are the different types of the letter of credit? So, first of all, there is an acceptance credit. An acceptance credit is a type of letter of credit where the issuing bank, upon accepting a draft from the seller, guarantees a payment at a future date. So, acceptance credit is what? In this letter of credit, the payment is not done immediate. Payment is actually done on a future date. Payment is actually done on a future date. Once the letter of credit is issued by the issuing bank and upon accept the draft from the seller, it issuing bank actually guarantees a payment at a specific or a future date that I will be paying to you, but after 30 days. That is the acceptance credit. Irrevocable credit. Irrevocable credit means when the letter of credit is neither be amended. There can be no changes that can be done in a letter of credit, neither it can be cancelled without the consent of beneficiaries. It is the irrevocable credit. Means you cannot revoke it, you cannot change it, you cannot amend this letter of credit. Now, a confirmed letter of credit, when you add on a confirming bank. So I have told you that confirming bank is not compulsory in each and every condition. When you add an extra layer of guarantee, exporter in his country add an extra layer of guarantee as a confirming bank, that the bank which is actually confirming the letter of credit that if anyone defaults, I will be responsible to for the payment to the exporter. Then it is the confirmed letter of credit. So there is acceptance which is actually to be paid on a future date. Everything is executed. Now the issue bank says that okay, I will be responsible for the payment after 30 days. Irrevocable, you cannot change or cancel the letter of credit. And third, a confirmed letter of credit, it means that you add on an extra layer of guarantee as a confirming layer. Now, letter of credit, there are different types of letter of credit. If we talk about with the recourse and without recourse letter of credit. Now, with the recourse and without recourse letter of credit is what? With recourse, first of all, with recourse letter of credit, that if the beneficiary is the seller, present a draft or a bill of exchange and it is not honored by the issuing or the confirming bank. Now, if the seller present everything to the issuing bank or the confirming bank, okay, but now it is not presented or not paid by the issuing bank or confirming bank. Now, in this case, the party, that means the seller, which has accepted, means like there is a confirming bank. Confirming bank has all the right to seek reimbursement from the party which has originally presented that document. Means that confirming bank should present that to the seller for the payment, right? For example, here always remember that with recourse is what? For example, there is a buyer. I'm just telling you examples. For example, there is a buyer global check, there is a seller euro component, there is an issuing bank, and there is a confirming bank. Issuing bank and confirming bank, these located in the seller's what sell means confirming bank, it is in the seller's location, and issuing bank, it is in the buyer's situation. Now, what is a with recourse credit? For example, Global Tech Limited, this actually buyer applies for a letter of credit from the Bank of Mellon in favor of the euro component. Simple. Now, Duchess Bank confirm the letter of credit and accept a draft from euro component. So here there is a confirming bank also. So Dutch Bank confirms the letter of credit, accept a draft from a euro component, means a seller. They accept the draft from the seller, guaranteeing payment at a future date. So if they says that if everything is executed, then I will be responsible for the payment, right? Now, if the Bank of New York fails to honor the draft, which when it's mature, now Deutsche Bank has done the payment. Deutsche Bank is the confirming bank, right? Seller has presented the documents or presented the letter of credit to Dutch Bank, and Dutch Bank makes payment to seller. Okay, now Dutch Bank has to receive the payment from issuing bank. Now, if at the date of execution, when the Bank of New York issuing bank fails to honor the draft, okay, Dutch bank means this confirming bank and now goes to the seller, which is the beneficiary, and demand for the repayment. It means that the Dutch bank may require euro component to pay back the amount if the Bank of New York doesn't pay the amount. This is the recourse. Now here is buying and selling between these two. There is an issuing bank and confirming bank. That seller presented that proper bill of exchange to the confirming bank, and confirming bank make the immediate payment to the seller. Okay, and this actually bill of exchange is of future date, that still the issuing bank has to make payment after 30 days. Now this bill of exchange is with the confirming bank, and issuing bank has to make payment to the confirming bank after 30 days. Now after 30 days, when confirming bank present this letter of credit to issuing bank, demands for the payment, and if issuing bank defaults of payment, okay, then confirming bank goes back to the seller and demand for the repayment of the complete bill of a letter of credit. Okay, whatever the payment the confirming bank has made to the seller, they have to give back to the confirming bank. Why? Because it is with recourse. Now without recourse, everything is same. Now in without recourse, if issuing bank defaults on payment to the confirming bank has no right to demand for the repayment from the seller. Now here the confirming bank has to what? Has to bear all the loss of non-payment from the Bank of Minutes. So this is with recourse and without recourse. With recourse means the confirming bank has all the right to claim for security, to claim for reimbursement of the money from the seller. Whereas in without recourse, the confirming bank has not the right for demand of the payment. Here, the confirming bank has to bear all the things, has to bear all the risk regarding the repayment of. Clear? Now, there are different types of letter of credit also. Okay, we are discussing about the different types of letter of credit. If we talk about the different type of letter of credit, first of all, there is a transferable letter of credit. Okay, transferable letter of credit. A transferable credit is one where the beneficiary can transfer the rights to the third parties. Okay, as already said, that letter of credit is not a negotiable instrument, okay, but a bill of exchange can drawn under it can be negotiated. So as such, the rights or under a letter of credit cannot be transferred, and it is vested only in the hand of beneficiary. Okay, once bills is negotiated, the entire transactions came to end. Okay. Okay, so always remember that in a transferable credit, the one who is entitled to receive the payment can pass on the right to receive the payment to any other parties. Back-to-back credit, in back-to-back credit, the beneficiary in whose favor, the seller in whose favor the letter of credit is issued, use the same to open another letter of credit from his bank. Okay, so if there is a letter of credit which is issued by the buyer's bank to the seller's bank, now this, in this case, the seller can use the same letter of credit in his favor for asking for another supply. For example, there is a seller. Now seller want to have that particular amount from that particular shipment from somewhere else. Now seller can use the same letter of credit for its buyer, and they just export it from here and send it to here. That is the back to back credit. Anticipatory letter of credit, in which the beneficiary, means the seller, is entitled to have a what, some advance before the shipment. Now, there is a green clause in which you will receive the advance, plus you will receive some extra cost to cover the storage and the shipment port, right? Revolving letter of credit means when there is a regular trade between the same parties, you don't have to issue every time the new letter of credit. The same letter of credit can be revolved in the upcoming transactions also. You just have to renew the terms and condition in the same letter of credit. Clear? So these are the different type of letter of credit. Now these are the documents which are needed in the letter of credit. So there is a bill of exchange which is needed, invoice, transport document, bill of lading, airways, post parcel, insurance, and other documents. So these are the different type of documents which are needed in the letter of credit. Clear? So this is the complete chapter. Okay, let's talk about some of the practice question. The first question is, the letter of credit is opened on the request of issuing bank, applicant, beneficiary, or confirming bank. So letter of credit is opened on the request of what? Everyone. Yes, the letter of credit is open on the request of applicant, which is also the buyer, or you can say the importer, buyer importer. Okay. Next, the letter of credit issuing bank is also called as dash. The letter of credit issuing bank is also called as the importer bank or opening bank, advising bank or confirming bank, negotiated or the nominated bank, or reimbursement bank. Everyone, everyone, please answer this question. The letter of credit issuing bank is also called as the importer bank. So, advising bank, confirming bank, or negotiating bank, these are it actually the exporter's country. Okay, we are going to discuss about the deferred payment guarantee. This is unit 33 PPB module B, the very simple unit. Okay, very easy unit, very simple unit. You will get this, right? So this is a very basic unit for all of you. Just everyone, just please like and share the video to the maximum you can. And if you haven't subscribed this channel yet, guys, it's a request that please subscribe this channel and press the bell notification icon. So let's start discussing that what is a deferred payment guarantee, right? So deferred payment, first of all, what is a deferred payment? For example, if we talk about the deferred payment is actually when the supplier, or when the supplier give you a time limit for the completion of the total amount which is involved in the trade, right? For example, you are a buyer is not paying the whole amount immediately. Buyer is not paying the whole amount immediately. Instead of paying the whole amount immediately, they just divide that amount into different units, into a proper fixed installment, which is spread over a period of time. Then it is known as deferred payment. Okay. Now, when there is, for example, import and export. Okay. When there is import and export, just a second. Give me 1 minute, guys. sorry, when we are talking about the import and export, right? So import and export means what? If we talk about the importer and if we talk about exporter. So in this particular circumstances, for example, this exporter exports some goods and the amount is worth rupees 10 lakh, right? Now, instead of paying immediately, the importer grant or importer request for a time limit, okay? Importer request a time limit, okay, and then this exporter has given the consent and just spread the amount into, for example, 12 equal installment, which is spread for a 1 year time period. Now, there may be a chances of default in the future. There may be the fraud that can happen. Importer may goes bankrupt, right? So in all these conditions, there is what? All these conditions, there is actually a thing that is requested by a exporter. So exporter, for the assurance of the repayment, the assurance the exporter just says to the importer that please provide me a guarantee on behalf of yours that if you default on payment, then on your behalf the installments will be paid by the what? The installment will be paid by any of the bank, right? So the importer goes to his bank and approach and just requested that please provide a guarantee on the deferred payment that if I default on any installment, so on my behalf you will be responsible for paying the money to the exporter. Now, this arrangement between the importer and the exporter and the guarantee that is given by the importer and the guarantee which is given by any of the financial institution or bank, the guarantee which is given by any of the financial institution or bank on behalf of the importer, then it is known as what? Then it is known as the deferred payment guarantee, right? Now, if we talk about the purpose of deferred payment guarantee, so purpose is very easy. For the exporter, the deferred payment guarantee act as a assurance of repayment. So if you are an exporter and there is a guarantee that is provided on the behalf of the deferred payment, it means that you are assured of the payment, because you know that if importer defaults on payment, then on behalf of the importer the payment will be made by whom? The payment will be made by the, right? Second, there is an importer, and importer also what? Also gets the safety of the amount which is involved in that machinery. For example, importing a machinery from USA, for example, right? Now from USA I'm importing some machinery, and in this machinery, for example, my currency or my Indian rupees depreciate more in terms of dollar. When my currency depreciate, I have to pay more in terms of what? I have to pay more in terms of, you can say, the money, or I have to pay more in terms of rupees for purchasing that particular machinery. So because of the foreign exchange and because of the fluctuation in currency, always there is always a thing that it either goes or it either goes down. It either goes up or it either goes down. Okay. So for maintaining the safety, this for maintaining safety on it, then there is a what? Deferred payment system that has been given as a solution. When the exporter and importer, they agrees that okay, we will provide this machinery as this rate is spread over a period of time into fixed installment, means the machinery cost is fixed irrespective of the foreign exchange. So importer will get a safety in terms of the unnecessary financial burden that may arise if the currency depreciate. Second, the exporter gets a confidence of repayment, because in a deferred payment, when the guarantee is provided by the bank or financial institution, they get assurance that if importer defaults on any currency, if importer defaults on any amount, then this will be returned by the bank or financial institution. So these are actually the purpose for the deferred payment, right? Next, how this deferred payment system work? Okay, first of all, it is that the fixed installment is spread for a period of either 1 to 7 years. So this is the time range. This fixed installment is spread over a period of 1 to 7 years, right? First of all. Second thing is, if we talk about the method of payment, there is an advance payment. First of all, there is an advance payment of 10 to 15% which is given on the prices of the goods, right? So first of all, the importer will receive an advance payment of 10 to 15%. Second is what? Second, another 10 to 15% is paid on the receipt of document which is given under the letter of credit. And third, the balance amount, this should be paid in installment for a period of 1 to 7 years secured by the deferred payment guarantee. So 10 to 15% advance, 10 to 15% on the receipt of the document provided in the letter of credit, and the balance it should be paid in the installment that is spread for a period of 1 to 7 years, and this is actually secured by the guarantee which is given by the bank or financial institution, which is the deferred payment guarantee. Clear? Now next, let's talk about the method of payment. Okay, now what is the method of payment? So method of payment is, first of all, a deferred payment guarantee assures that there should be a timely payment of the installment and interest, if any. Means the guarantor is responsible not only for the principal amount, the guarantor is also responsible for the interest amount. So there is a guarantee of the payment for the installment as well as the interest. Second, there is a supply of goods by the seller to the buyer, and the seller agrees to postpone the payment of price, and the seller agrees the postpone of the price. Again, the payment schedule of both the installment and interest. And third, that is unconditional and irrevocable assurance by the bank. So the bank should give the conditional and irrevocable assurance of the bank. It means that, for example, this importer has received some good, but it is not as per the quality which is mentioned or as per the quality. Now, for example, this importer calls to her bank and says that you don't just revoke your guarantee. I'm not paying the installment, neither you will pay the installment because this is not a quality good. So in this case, bank will reject this plea. Why? Because bank says that no, this is a unconditional and irrevocable assurance of the bank. And when I have given that assurance that only the exporter has exported you the good, if you refuse the delivery of the good, then there is no point that we are revoking back that guarantee. You are responsible for the payment of the installment, and if you are not paying the installment, then on your behalf, I will be responsible for paying the installment and later I will recover it from you. So, in the deferred payment guarantee, this is not the way that you have to assure the what you have to assure the quality, or you have to assure the time. Okay, so it says that it is unconditional and irrevocable assurance of the clear. So this is the whole deferred payment guarantee system. Now let's talk about some of the practice question associated with this deferred payment guarantee. So you have to answer which of the following statement is false here. Please answer this question. Which of the following statement is false here? First of all, in a deferred payment guarantee, the guarantee is to ensure the delivery of good. Second, in a deferred payment guarantee, it mostly based on the primary contract between the buyers and seller. Third, a deferred payment guarantee differs from other kind of guarantee issued by the bank. Fourth, in a deferred payment guarantee, the bank's liability come into existence only if all the installments are not paid and not on the non-payment of any installment by the customer. So you have to answer this question. Which of the following statement is false regarding the deferred payment guarantee? Which of the following statement is false regarding the deferred payment guarantee? Everyone please answer this question. Which of the following statement is wrong regarding the deferred payment guarantee? Everyone please answer this question. Deferred payment guarantee. Which of the following statement is wrong regarding the deferred payment guarantee? So, if we talk about the deferred payment guarantee, first of all, in a deferred payment, the guarantee is to ensure the delivery of the good. No, the guarantee is actually for the repayment of the EMIs. Second, in a deferred payment guarantee, it is mostly based on a primary contract between buyer and seller. Yes, it is a correct thing. A deferred payment guarantee differs from other kind of guarantee. No, it is just like the other guarantee that is given by the bank. Now, in deferred payment guarantee, the bank's liability only come into existence if the installments, all installments are not paid, and not just the non-payment of any one installment. No, it is actually applicable only at one installments also. If you have not paid the one installment, then only it is applicable, right? So the first, third, and fourth is wrong. Means C is the correct answer. Clear? We are going to discuss about this unit, that is loss related to bill finance. So we are going to discuss about the loss related to bill finance. Okay, this is unit 34, PPB module B. Okay, everyone, just please like and share the video to the maximum you can. And if you haven't joined this channel, or if you haven't subscribed this channel yet, is a request, guys, that please subscribe this channel and press the bell notification icon, right? So let's start this topic, that is laws related to bill finance. The very first thing is, there are which law is actually related with the liabilities and rights of the parties. The very first thing, that which law is related with the liabilities and rights of the party. So that law is known as the Negotiable Instrument Act. That law is known as what? Negotiable Instrument Act. Negotiable Instrument Act is the main act which is responsible for governing, or which is responsible for maintaining or regulating the liabilities and rights of a partner. Now, talk about section 5 of Negotiable Instrument Act. There is a Negotiable Instrument Act 1881, and section 5 of Negotiable Instrument Act 1881 defines that instrument in writing containing an conditional order signed by maker directing a person to pay sum of money, directing a person to pay a sum of money, that is only, or to the order to a certain person, or to the bearer of the instrument, then it is known as what? Then it is known as the Negotiable Instrument Act. So Negotiable Instrument Act is defined as what? Negotiable Instrument Act, Section 5 of Negotiable Instrument Act actually defines the bill of exchange. It actually defines what? It actually defines the bill of exchange. Come here, okay? So bill of exchange, or you can say, the thing is, it has said that if there is any instrument, if there is any instrument which is in written and it contains an unconditional order, first of all, it should be an unconditional order signed by the maker, signed by the maker, directing a certain person pay a sum of money to the order certain person, then it is known as the what? Then it is known as the section 5 of Negotiable Instrument Act. Now, in section 5 of Negotiable Instrument Act, there is a bill of exchange. Now, what is a bill of exchange? I'm just giving you an example. For example, there is the seller and there is a buyer, right? Now, there is a buyer, there is a seller. Seller sell goods to buyer, right? And buyer has to pay money to the seller. Instead of the immediate payment, this buyer demand a time period for the repayment of this transaction. Seller agrees. Seller says that, okay, sellers grant this buyer a time period of, for example, 30 days. That, okay, you will pay for this transaction after the 30 days, right? Now, for just confirming and making this thing legal, seller draws a bill of exchange on buyer. Instruct buyer that you have to pay this certain sum of money after 30 days to me. Okay, so that is known as the bill of exchange. Clear? Now, in this, seller who is actually making the bill of exchange is called as the drawer. The seller is what? The seller is the drawer, or you can say the maker of the bill of exchange. Whereas the buyer is known as what? The buyer is known as drawee. Drawee means the one person who is instructed to make the payment, right? And then there is a person who is known as payee. Payee is the person who is entitled to receive the payment, right? Payee is the person who is entitled to receive the payment. Clear? Now, if we talk about this transaction, payee is what? Payee is the seller. So, in this scenario, payee and drawee, they are the same person. In this scenario, payee and drawee, they are what? They are the same person. Clear? Okay, done. Now, there is a different scenario in which there are three different parties. Let's talk about that. A sells good to B. Instead of the immediate payment, we demand a time period for the repayment. A agrees. For legalizing this, A just draws a bill of exchange B, instructing B that you have to make payment after 30 days to C. Okay. Now, here A is the seller and he is the maker of the bill of exchange. B is the drawee, the one person who is given instruction to pay, right? And C is the pay, the one who is entitled to receive the payment. So there can be the drawer means maker and payee. They can be the same person, or there can be the drawer or the payee. They can be two different person in the bill of exchange. So bill of exchange has actually three parties. Sometimes it has two parties, sometimes it has three parties. There is a payee, there is a drawer, there is a drawee, right? And if we talk about the payee, payee is also what? Payee is also the drawee. Clear? Payee can also be the drawer, means the maker, right? Now, some of the important provisions of the Negotiable Instrument Act. If we talk about the important provision, first of all, there is a holder. There is the holder in the bill of exchange. Now, who is the holder? According to Section 8 of Negotiable Instrument Act, holder is defined as the person who is entitled in his own name to possess the bill and recover the amount of money. The one person who actually possesses the bill of exchange and he is entitled to recover the amount of money, that person is known as holder, which is according to Section 8 of Negotiable Instrument Act. Clear? Next, if we talk about the next, that is the holder in due course. Holder in due course, it is as per the section 9. Holder in due course means in any person whose consideration become the possessor, means to whom the bill is transferred. For example, I am the holder of bill of exchange, means the very first thing that I possess the bill of exchange and I am entitled to receive the payment. But I have endorsed this bill to you. For example, I have endorsed this bill to you. It means that you are the holder in due course. It means that you are entitled to receive the payment. Clear? Payment in due course means what? Payment in due course means you have to pay full the bill of exchange according with the apparent tenure. Apparent tenure of the bill of exchange means whatever it's written in the bill of exchange, you have to make payment according with the apparent tenure of the bill of exchange to holder or holder in due course in good faith without any negligence, right? Now, negotiation is what? Negotiation is defined under section 14 of Bill of Exchange. Section 14 says that when the bill is transferred for consideration to a person so as to entitle him to claim the amount of bill, that is called as negotiation. Means that when the bill is transferred, okay, for some consideration. For example, I am the holder of bill of exchange, but now I want an immediate payment. I can't wait for 30 days, or I can't wait for the time period which is mentioned in that bill of exchange. I just go to a bank okay, and says that please hold this bill of exchange. Under this bill of exchange, you will receive the payment after 30 days. Kindly give me some money after deducting the discount from it, right? That bank take the bill of exchange and gives you 90% of the bill of exchange amount. So this is known as what? This is known as negotiating bank or negotiation. Negotiation means the one person to whom the bill is transferred for some consideration, right? Endorsement, that if the holder sign the bill of exchange for the purpose of transferring it, such signature is known as endorsement, which is according to section 15 of the negotiable instrument. Very important. Now, there is a liability of drawer. Liability of drawer, it is as per the section 30. The drawer is a bond in the case of dishonor, means failure to pay, to the drawee or acceptor to compensate the holder, providing due notice dishonor after have given and received by the drawer. So what is the liability of the drawer here? For example, A has drawn a bill of exchange B, instructing B that you have to make payment to C, right? If after 30 days B defaults on payment to C, if after 30 days B defaults on payment to C, right? Then, then what? Then A is responsible for paying to C, right? So it is the responsibility of the drawer, it is the responsibility of the maker that as per the section 30, you have to make payment if B or drawee fails to repay the fee. Clear? Everyone? Everyone, guys, just please like and share the video to the maximum you can. Whoever is watching this session, it's a request that at least please like the video and share the video to the maximum you can. Okay. Now, what is the liability of the acceptor or the drawee of the bill? Now, what is the liability of B? The liability of B is that B has to make payment with apparent tenor of the bill of exchange. Whatever the amount which is mentioned in that bill of exchange, whatever the time period is mentioned in that bill of exchange, the liability of the acceptor or the drawee is that you have to make payment as per the apparent tenor of the bill of exchange, which is according to section 32 of the Negotiable Instrument Act. Okay. Now, what is the liability of the endorser? What is the liability of the endorser? The one who is endorsed or who has endorsed the bill. Okay. So, section 35 provides that in the absence of the contract, any contrary, whoever endorses and delivers a negotiable instrument is bound thereby to every subsequent holder in the case of dishonor unless his liability is executed. For example, now in this case, C is entitled to receive the payment. C has endorsed bill to D, right? Okay, now if B defaults on payment to D, then C is responsible for paying to D. Okay. Now, for example, D has endorsed this bill to E. Now, B is entitled to payment to E. Now, if B defaults, then D is responsible for payment to E. Then, for example, E has endorsed bill to F. Now, here B is responsible for making payment to F, right? But if B default, then E is responsible for payment. Every subsequent person is responsible for the payment of the bill unless his liability is executed, right? So, this is what? This is the bill of exchange, right? Interest rate is specified. So section 79 says that if there is an interest rate which is expressively made on the bill of exchange, the interest will be calculated at such rate. And if there is no rate of interest is specified, section 80 says that now the interest is calculated at the rate of 18% per annum. At the rate of what? 18% per annum. Clear? So there is a holder in due course, payment in due course, negotiation, there is an endorsement, there is a liability of the drawer, there is a liability of the acceptor, there is a liability of the endorser, there is an interest rate specified, there is when there is no interest rate specified. See, sections are very important. You have to learn each and every section carefully. Just please learn these each and every section carefully, which is very, very important to all of you. Clear? Okay. Then now next, there are the classification of bill. Though bill of exchange is actually classified on the you can say places, okay, or on the classification or on the criteria of the period and on the criteria of nature. If we talk about the places, there is an inland bill and foreign bill. If we talk about the period, there is demand bill or usance bill. If they talk about the nature, there is a clean bill and documentary bill. About the inland bill, right? So inland bill means that the bills are drawn in India and payable upon any party which is residing in India. These are the inland bill. Means everything is done within the domestic boundary of India. Means bill are drawn in India, means drawer is in India and the drawee is also in India. Then it is known as inland bill. Okay. There are two conditions of the inland bill. First, it must be drawn and made payable in India. It should be drawn in India. It should be made payable to India. It must be drawn in India upon some person resident in India. There is a foreign bill. Now, Section 12 of Negotiable Instrument Act define the foreign bill. Section 12 of Negotiable Instrument Act defines the foreign bill. What is Section 12 says that bills drawn outside India made payable in or drawn upon any person resident in India or outside India. So if there is a bill which is drawn outside India, so drawer is outside India, the bill is drawn outside India, but it is paid to any of the person or the party which is residing in India, okay, or it is drawn on any person resident in any country outside India, then it is what foreign bills. First says that bill drawn outside India, okay, and made payable to any party that is residing outside India, then it is the foreign bill. Second, bill drawn outside India. Bill drawn outside India and made payable in or drawn upon any person resident in India. Then these are known as the foreign bill. Now, there are two more bills on the basis of the period. There is a demand bill and usance bill. Now, demand bill, very easy, very simple, very easy. Demand bill means when a specific date of payment is not defined. When there is no time period for the payment is specified. Demand bill is also known as side bill, means whenever payee present it for payment, you have to make the payment to payee. Then it is known as demand bill, which is section 19 of Negotiable Instrument Act. There is a usance bill. Now, what is a usance bill? A usance bill is a bill payable otherwise on demand and specifies normally on the payment. So there is a particular time period which is fixed for the payment. If, for example, 30 days is mentioned in that bill of exchange, it means that the payee has to present that bill on that date. Okay. Demand bill is the site bill, whereas usance bill is also known as bill payable after site. The drawer draws a bill of exchange and specifies a time within which the payment shall be made. Once the drawer accepts the bill, the drawer at the time or the date specified on that bill of exchange can present the same to drawee and demand for the payment. Okay, the date specified for payment is called as the maturity or due. Clear? Then there is a clean bill and documentary bill. Then there is what? Clean bill and documentary bill. Now, clean bill as is a bill of exchange that is not supported by any document. Okay, you don't have to present any document with that bill of exchange. The bill of exchange is the sole document you have to present for receiving the payment. Okay, that is known as clean bill. There is no other supporting document you have to give for the what? For the receiving of the money, right? So clean bill is which is not supported by any documents or title of code. Documentary bill. Documentary bill means which is supported by the title of the good. Now, under documentary bill, we have what? We have the bill drawn with an instruction to deliver the document against the payment. It means that this transaction for the supply of good, a seller draws a bill on a buyer, send same to his banker along with the documents like bill of lading, railway receipt or lorry receipt. The seller instruct the bank to deliver the bill and documents only when the buyer pays the price of the good. Means that the bill is exchanged. The bill of exchange is actually drawn, right? Now, once the buyer has paid the price for the good, then only the banker has to deliver the bill and the documents of the title, means that I am the owner of this good, to the buyer, right? So it is actually with instruction that first the buyer has to make payment and clear the bill of exchange, then only the buyer will receive the documents and other possession documents regarding the good, right? Now, second is the bill drawn with the instruction to deliver document against acceptance. So here in this, the seller instruct the banker that when the drawee accept the bill, if the buyer accept that okay, I will be paying for this bill of exchange, after acceptance, you can deliver the documents to the person or to the buyer. Clear? So this is the documentary bill. Now there are different type of bill finances. Like there is a bill purchased. Bill purchase means when a bank negotiate bill payable on demand, whether clean or documentary, it is known as a bill purchase. Means when the bank negotiate, means bank accept that bill of exchange in consideration, okay, then it is known as bill purchase. Now the face value of the bill is immediately paid to the holder. The bank after the purchasing will become the holder in due course and acquire all the right of the ownership over the instrument. There is a bill discounting which you already know, which I have already explained. Advance against bill for collection, when the bank actually gives advance against the bill, okay, which are in the course of collection, that facility is known as advance against bill for collection. Under this facility there is a margin which is kept by the bank and the net amount is paid to the customer, right? Bill is sent for collection, then in the case the banker who lent money becomes the holder in due course for that, right? There is a bill discounting and the right of banker, in which if the drawee is not paying the amount, then the bank has the right to recover the money from the seller, right? Legal relationship in the case of bill discounting. In bill discounting, a bank becomes the lawful holder of the bill and becomes the payee of the bill. So these are the different bill finance and legal position of the banker. Clear? So this is the whole chapter. Let's talk about some of the questions, related questions of this class. First of all, bill of exchange means an unconditional direction to the drawer to pay the money, promise to the drawer to pay the money, obligation to the drawer to pay the money, and undertakings to the drawer to pay the money. Everyone please answer this question, guys. Everyone please answer this question. Bill of exchange means an unconditional. Unconditional. I have told you bill of exchange is what? Unconditional order that is signed by the maker directing a person, right? So unconditional what? Unconditional order. Okay. So there is a direction to the drawer pay the money. Drawer is not responsible for paying the money. Drawer is actually either entitled to receive the payment, right? Promise to the drawer to pay the money. Yes, so it is actually the unconditional promise that you have to pay to the drawer to pay the money. Clear? Yes. The maker of bill of exchange is called as. The maker of bill of exchange is called as. The maker is also called as the drawer. The drawee is the one who is entitled to pay. Okay. Last, bill purchase facility is granted in the case of. Bill purchase facility is granted in the case of what? Bill purchase facility. Bill purchase facility is granted in the case of use.
We are going to discuss about unit 35, that is personal loans, right? So personal finances, there are different type of loans that has been given by the bank. We have the home loan, we have the credit cards, we have overdraft facility, we can say there is a vehicle loan, gold loans. There are different type of loans that has been given by the bank, right? So all this we are going to discuss in today's chapter. So everyone who is watching this video, just please like and share the video to the maximum you can. And if you haven't subscribed this channel yet, it's a request guys that please subscribe this channel and press the bell notification icon. Everyone guys, hi, hello, good evening. Yes, okay, so let's start with the personal finance topic. Very first thing is home loan. Okay, first we are talking about the home loan. So what is actually the home loan? Okay, so home loan, first of all, who is the target group for this home loan? So there are salaried class. Okay, these loans are given to whom? These loans are given to the salaried class, professionals, self-employed businessmen. So all the home loans, these are given to each and every individual who has the capability to repay back this loan. Who has what? Capability to repay back this loan. So salaried class, business class, there's a professionals or self-employed, or there is a businessman. These are all eligible for the home loan. Plus the main important thing is you should have the capacity or ability to repay back the home loans, right? For example, if there is any government employee, for government employee, home loan is very easy, because see, when we are talking about the home loan, it particularly goes for a period of, for example, 10 years or even 15 years, right? And in private sector, there's no job security until and unless you are holding a very good position in any of the industry, right? So home loan, the targeted persons are obviously those who have the ability to repay back the loan in time. Repayment period for that is fixed, right? And home loan, these are given to Indians also, and these are given to NRIs also. So if we're talking about the home loan, these are given to every individual. These are given to individuals also, and these are given to what? These are given to the NRIs also. Just a second. Just a second, guys. Okay, so there is something wrong. Okay, no issues. Let's come back to the home loan. Okay, for what purpose the home loan is actually given? So if we talk about the home loan, this is given for the purchase of house plot. You can purchase the housing plot for construction. You can purchase the you can just take this loan for the construction of of your home or flat. For the repair and renovation of the house, bank is also giving the loan, right? Quantum of the loan amount is decided on upon your gross monthly salary. Same thing, that if you are able to repay back the amount, okay, the home loan is depending upon what? The home loan is depending upon the gross monthly income and net monthly income and the cost of household, right? For this, the bank can ask income proof document. So there is a can be an income proof document, salaried class, or the income tax return and the statement for the bank account for the past period. Age, if we talk about the age, bank sets the lower and upper age limit, which take into consideration the remaining period of services. Repayment time period can extend up to 30 years also. Normally it can range from 15 years, 10 years to 15 years, right? And it can be up to 70, or sorry, 30 years also, depending upon what type of customer you are. Clear? Now, if we talk about the home loan, because the amount is very big, and plus this amount is involved for a long period of time. This home loan is sanctioned, for example, that for example 70 lakhs or 80 lakhs or even 1 crore, right? So there is a big amount.
and that is two for a long time period, right? So track record. So if we talk about the track record, the credit history of the borrower is actually what very important for dispersing of the home loan. You should have a good credit score. You should have a good repayment history for giving or for the sanctioning of the home loan. Security mortgage on that property should be there. It means that mortgage, first of all, is related to immovable property. You all know, right? So you can use that property. You are living in that property. Everything is good, but that property is kept on a mortgage to the bank. It means that if you default on the loans, then what the bank will have the power to sell the property and recover the loan from there. If we talk about the interest rate, the different bank charge different interest rate as per their own policy. This can be fixed also, this can be flexible also. Obviously, it should be as per the RBI's guideline. Whatever the RBI has given instruction, it should be under that, right? It is good. But banks are free to charge their own interest rate, and obviously they are actually doing competition basis on that also, right? So if PNB is giving some percentage, SBI is competing with PNB and giving you a lesser interest rate on the home loan. It's always depend. When we customer, as a customer, we are going to a bank, we just not only look on the interest rate. We are just looking on each and everything. What should be the early repayment penalties that the bank is imposing? How quickly the loan is disbursed? How good the bank is actually giving you the services? All thing that is taken into consideration, right? Now, if we talk about customer suitability and transparency, so when there is introduction of any product into the thing, banks should take into account the customer suitability and appropriateness, that the borrower are fully aware of the risk and liability. So if as a banker you are dispersing home loan to any customer, that borrower should be fully aware of all the risk and liabilities that involve in that particular home loan, right? So the risk, the liabilities that should be particularly there for the dispersing of the. Clear, everyone? Just please like and share the video to the maximum you can. Everyone who's watching this video, everyone who is watching this video, it's a request that please like and share the video to the maximum you can. Everyone, guys. Okay. So next, if we talk about the prohibitions, so what for what purpose the home loan is not given? So bank is not giving grants for financing of the construction of building, just meant for government or semi-government offices. So if you are in the process of building some government or semi-government offices, bank is not giving you that loan, because that loan is actually financed by NABARD. Okay. If there is any project that is undertaken by the public sector entities which are not any corporate bodies, these also not financed by the bank, again because these loans are sanctioned by different development financial institutions, right? Now, if we talk about the lending to housing intermediary agencies, so there are housing intermediary agencies, means which construct the house and then sell to different individual. Like there is a builder who is building the society, there is a builder who is building the complete flats, right? So these are housing intermediaries. So loans are also given to the housing intermediary. Like the loan can be given for the land acquisition, the loan can be given for housing finance institution, the loan can be given to housing boards or other agencies. The term loans can be given to the private builder. Okay, so these are the home loans, right? Now, the quantum of home loan, if we talk about the quantum of home loan, yes, in deciding the value of the house property, stamp duty, registration, and documentations have to be excluded. So if we have want to decide the home loan, the quantity or what is the value of that complete site, we should exclude what? We should exclude the stamp duty, we should exclude the registration, and we should exclude the other documentation. We should exclude these things, right? Now, if we talk about the category loans, loan to value ratio, if we talk about loan to value ratio, if the amount is, if the loan size side's amount is up to 30 lakh. If the loan side amount is up to 30 lakh, then the loan to value ratio is less than 80%, right? So the bank is giving you approximately 80 or less than 80% of the loan. And if it is up to 30 lakh, okay, it can be what more than 80% also, but less than 90% in some cases. Now the risk weight here is 35 and here is 50%. If the site valuation is 30 lakh and up to 75 lakh, then it is less than 80%. Again, the risk weight is 35%, and over and above 75 lakh, then it is 75%, means less than 75% loan is sanctioned for that site, and the risk weight is here is 50%. Clear? Now, what are the different type of documents that are needed for the home loan? So these are the different type of documents that are needed for the home loan. For example, we should have a agreement of sale or sale deed. Okay, then there should be no certificate, encumbrance certificate. There should be a title search document for complete 30-year, approved building plans. There should be a patta, NOC from housing board. Okay, that there is no objection to build the houses from or on this side. Valuation report from the bank approved engineer. Bank statement for the last 12 months should be there, right? Salary certificate for the self and spouse should be there as a proof of employment, right? IT returns for complete 3 year in the case of you are a professional businessman or self-employed. KYC should be there. So these are actually home documents which are required for home, right? Now, disbursal of the home loan. If we talk about the disbursing the home loan, first of all, approval from regulatory authority or statutory is needed. So bank need to ensure that the borrower has obtained the required permission from the government or any local government or any statutory body for the project. So if you are going to start any project, bank need to ensure that the borrower should have a prior permission for government, local government, or other statutory authorities. The stages of construction. If we talk about the stages of construction, housing loan for the complete house, the dispersal is done lump sum at the time of purchase or acquisition. For example, you have to just purchase the already move-in flats, right? So a lump sum amount is given so that you can just pay for the purchasing of that home, and then you start living in that. When there is any house or apartment that is under construction, so the loan is given as per the stages of the development, right? So it is actually dispersed according to the stages of the construction. When a borrower opt to repay their loan or foreclose it, okay, so there are actually some penalties for the early repayment of the loan, and that is according to every or her there is penalties and charges from each bank if you want to foreclose or if you want to have an early repayment of that loan, right? And this particular thing just frustrate the borrower, right? So Reserve Bank of India has addressed this issue and instruct the bank that they cannot charge any foreclosure charges or prepayment penalties on the home loan, right? Because this actually aims that the borrower who wants to pay off their loans early, and they should want to have a benefit from the lower rate which is offered to any other banking institution, they can just avail that. And that's why Reserve Bank of India ordered that there should be no what early repayments, or there is no charges on prepayments on the penalties of the home loans, right? So these are the home loan. Now next we are going to discuss about what? Next we are going to discuss about the personal loans, right? Everyone who is watching this video, just please, everyone, just like and share the video. Okay, so now we are going to discuss about the personal loans, right? Generally, bank give loans for specific purpose against some security so that it can fall back on the case of the default. So there are personal loans also that has been disbursed by the bank against some security. However, sometimes loans are against personal loan without any tangible security, and these are called as salary loan. Your loan is disbursed on the basis of your salary, loan is given to the pensioner, loan is given to the professionals, right? Now, what are the procedures and what are the practices for the salary loan? If we talk about the procedure and practices for the salary loan, first there is a target group. Who are the target group? Permanent employees are the target group, which have a minimum service experience of, for example, 3 years, right? For what purpose the personal loans are disbursed? So personal loans are disbursed, for example, for educational, marriages needs, medical, family functions, or any household expenses. You want to have a personal loan, go have it. The personal loan, it can be for anything. It can be for the marriage expenses, it can be for education, for your education, or for your children education, medical, family functions, anything, right? So these personal loans are given not on the basis of tangible securities. These are oftenly given to the pensioner or professionals, or to any individual, or salary loan to any individual, which is judged on the basis of their salary, how much income you are earning monthly, right? Eligible amount, again, it is calculated on your gross net salary. Okay, next, security. Generally, there is no security which is given. In the case of personal loan, the borrower has don't have to give any collateral for the personal loan. Bank may ask for the third party guarantee. Bank may ask for what? Bank may ask for third party guarantee. Now, what are the documents? So proof of employment should be there, salary certificate should be obtained, right? Other aspects, if we talk about the different aspects, the rate of interest will be higher than for other loans, as there is no collateral security. Okay, so rate of interest is what? Rate of interest is higher than for other loans, as there is no collateral security. Bank should accept the ECS debit mandates. Okay, bank will allow 36 to 16 months as a repayment period. Normally, bank can levy a certain percentage of the loan amount as a processing fees. Okay, so these are the characteristics of the personal loans. Okay, this is it. This is the two. I have just discussed the two loans: home loans and personal loan. We have just discussed the two things: home loans and personal loans, right? For there are different type of other loans also. Vehicle loans is there. There is the gold loan also, and there are different type of loans. But I just discussed some of the important things related to this chapter. Let's talk about the practice question. When the bank give home loan, the nature of charge created is, now when the bank is giving you the home loan, the nature of charge is what? Hypothecation, mortgage, assignment, or pledge. Everyone, when the bank gives you the home loan, the nature of charge created is dash. Everyone, when the bank give home loans, the nature of charge created is dash. So if we talk about the correct answer, when the bank give home loans, the nature of the charge is created as mortgage, because mortgage is related to immovable property. Mortgage is related to immovable property, and hypothecation is related to movable property. We are going to discuss Unit 36 of PPB Module B, that is Priority Sector Advances. Okay, so everyone, whoever is watching this video, it's a request that please like and share the video to the maximum you can. And if you haven't subscribed with this channel yet, it's a request, guys, that please subscribe this channel and press the bell notification icon. Everyone, just please subscribe this channel and press the bell notification icon, guys. Okay, so let's start discussing this priority sector advances. Okay, so what are the priority sector advances? First of all, if we talk about the priority sectors, so the priority sector, the description of the priority sector, it was actually formalized in 1972 on the basis of the report which is submitted by the informal group, study group, and this is constituted by Reserve Bank of India in May 1971. So the priority sector advances, this was actually formalized in 1972, and it was actually set up by the Reserve Bank of India report, which which was constituted and which was passed in 1971, which was passed in 1971. Clear? Now, if we talk about the 1980, all the commercial banks were advised to achieve the target of priority sector lending at 40% by 1985. So, priority sectors are identified in 1972, and lending to these sectors is called as the priority sector advances. And overall, all the commercial banks were given this target that you have to lend at least 40% of your total deposit in the priority sector or as a priority sector advances. And this you have to achieve by the year 1985. Clear? Now, there are some targets and there are sub targets in the priority sector advances. So, overall, if we talk about the total priority sector, total identified priority sector. So, if we are talking about the domestic commercial bank, which exclude RRBs and special or small finance bank and foreign banks which have the branches of 20 and above. So, if there is a domestic commercial bank, and if there is a foreign bank or there are foreign banks who have 20 branches and above, the total priority sectors here is 40% of ANBC or okay, 40% of adjusted net bank credit or CEOBE, right? Whichever is higher. CEOBE is credit equivalent of balance sheet exposure. So we have to calculate ANBC, we have to calculate CEOBE. So 40% of ANBC or CEOBE, whichever is higher, is actually the total you can say target which has been given in the priority sector advances, right? So if there is a foreign bank, okay, and foreign banks have the less than 20 branches. If there are foreign banks which have less than what 20 branches, you have to lend 40% of ANBC, okay, or CEOBE, whichever is higher. Plus, here you can lend 32%, especially in the export sector, and 8% in the other priority sector. So if you are a foreign bank which have less than 20 branches, then the target is 40%, right? But under this 40%, you can lend up to 32% only to the export credit, and the rest 8% you can lend in the other priority sectors, right? Now, regional rural bank for RRBs, the target is 75% of ANBC or CEOBE, whichever is higher. Now, under which you can lend especially to micro, small, and medium enterprises, social infrastructure, and renewable energy. And this can be only up to 15% of the ANBC. Now, small finance bank, again 75% of ANBC or CEOBE, whichever is higher. ANBC is adjusted net bank credit and CEOBE is credit equivalent of balance sheet exposure. Clear? Now, next, if we talk about the agriculture, what are the targets which are given to agriculture, the priority sectors in agriculture, right? So, if we talk about the agriculture, 18% of ANBC. Okay, so agriculture is 18% of a what of ANBC or CEOBE, whichever is higher, right? For the foreign banks who have less than 20 branches, no target is given in the case of agriculture sector. If there is a regional rural bank, 18% of ANBC or EEOBE, whichever is higher. And then if there is a small finance bank, again 18% of ANBC or CEOBE, whichever is higher. Micro enterprises, 7.5%. Okay, of ANBC or CEOPE, whichever is higher. It is not applicable in the case of what? It is not applicable in the case of foreign banks. Then in this case, it is 7.5% of ANBC or CEOPE, whichever is higher, and 7.5% of ANBC or COPE, whichever is higher. Same. Okay. Now next, if we talk about advanced to weaker section, here it is 12%, here it is 15%, or here it is 12%. It is for those commercial banks and for all commercial banks and for all those foreign banks who have more than 20 branches. Here, all the foreign banks who have less than 20 branches. This is for small finance bank, and this is for regional banks, regional rural bank, and this is for small finance bank. Clear? Now, if we talk about the updated year-wise target that has been given to the priority sector. First of all, if we talk about 2020 to 2021, 8% here and 10% here. 2021 to 2022, 9% small and marginal farmer target, 11% weaker section target. 2022 to 2023, 9.5%, here it is 11.5%, and 2023 to 2024, 10% here and 12% here. Clear? Now next, if we talk about the categories of the priority sector, so you all know that there are 8 categories of the priority sector. You all know that there are what? There are 8 categories of the priority sector. Now, what are these 8 categories? Okay, so first of all, there is an agriculture. So very, very important if we are talking about the categories of priority sector, very important. 8 categories of priority sectors are there. There are agriculture, MSME, micro, small and medium enterprises, export credit, education, housing, social infrastructure, renewable energy and others. So these are the 8 categories of the priority sector. Now, if we talk about the agriculture, okay, if we talk about the agriculture, so agriculture in which there are farm credits, which are loans to individual entities engaged in the agriculture and allied activity. Agriculture and allied activity means that is related to fishing or farming, etc. Agriculture infrastructure, the sanctioned limit is what? 100 crore. Okay, there are some ancillary services, means add-on services, that loan for food and agro processing is also lent in the agriculture sector. A specified deposit, it is with NABARD, National Bank for Agriculture and Rural Development, and small and marginal farmers, it is as per the specified criteria, which include to their self-help groups, right? Now, there is a micro, small, and medium enterprises, MSME. There is a micro, small, and medium enterprises, which is MSME. So, all bank loans to micro, small, and medium enterprises just conform to the specified guidelines. Okay, and here the transaction is actually with recourse basis when the assigner is MSME. It means that when there is micro, small, and medium enterprises, loan has been given to micro, small, and medium enterprises. Okay, and when there is a forfeiting on this transaction, then whoever is the forfeiting agency, if for example they cannot recover the complete payment from the debtor, then obviously they can demand for the repayment from the seller. When they demand for the repayment from the seller, then it is known as with recourse. Now, loans unit here to Khadi village industry sector, this is also included in the micro, small and medium enterprises, right? This is also included in what? Micro, small and medium enterprises. Clear? Done? Everyone? Okay. Now, housing. If we talk about the housing, loans to individual can be given for the purchase, construction, and repair of the dwelling unit. It is for the purchase, for the construction, for the repairing of the dwelling units, right? It is for any governmental agency for construction of the slum dwellers. Loan which is given to affordable housing project. Loans which has been given to microfinance companies, housing loans which are granted individual, that is up to 35 lakhs, okay, in the metropolitan centers which have the population of above 10 lakh. These are all treated as the priority sector advances. Okay, now if we talk about the social infrastructure, yes, loan for schools, drinking water facilities, sanitation facilities, these are all the social infrastructure. Credit to microfinance institution for on lending for similar purposes, housing. Okay, these are all considered under the social infrastructure. Renewable energies. So if we talk about the renewable energy, if we talk about the loan, if it is given for the solar based generation, biomass based power generators, windmills, micro hydel plants, non conventional energies, these are all come under the renewable energy, right? Others, if we talk about the others, the loans to individual self-help group. Okay, there are loans which are given to social needs, housing, common activities. There are loans given to distressed farmers, startups loan, state sponsored organization. These all are characterized, or these are all come under the priority sector. These are all the weaker sections. If we talk about the weaker sections, who are the weaker sections? So these all come under the weaker section. For example, small and marginal farmers, these are the weaker section. Artisans, village, cottage industries, okay. Then beneficiaries which are under any government sponsored scheme, that for example there is a national rural livelihood mission, there are national urban livelihood mission, there are self-employment scheme for rehabilitation of manual scavengers, right? SCSTs, beneficiaries of differential rate of interest, self-help groups, distressed farmer, distressed person, individual women beneficiary, person with disabilities, minority communities, these all come under the weaker sections. Clear? Sorry. Now these are some of the common guidelines for the priority sectors loan. First of all, the rate of interest should be strictly as per Reserve Bank of India's direction, right? Now, no loan related add-on services or inspection charges if the loan is given up to rupees 25,000. Record of the loan, you should have the record of all the loan, the date of receipt, sanction, rejection, disbursement. You have to maintain everything and show to the inspecting agencies. Acknowledgement of the loan receipt should be given that the bank has taken the decision to be communicated in written within the time limit specified by the board. So these are the common guidelines for the priority sector loans. Discuss about agriculture finance. This is PPB Unit 37. Okay, so let's start discussing this topic. Okay, first of all, if we talk about the loans, so there are three type of loans. If we talk about the basic introduction, there are three type of loan. We have short term loan, we have medium or long term loan, right? And we have the crop loan. So first of all, if we talk about the short term loans, loans are repayable up to 18 months. Okay, the loans which are repayable up to 18 months, these are called as the short term loan. इसे हम we have to termed it as short term loan when the loans are repayable to 18 months, and it includes what? It includes crop loan, kisan credit card, it includes the loan against gold ornament for any agriculture purpose, right? Now we have the medium to long term loan. Medium to long term loan, the period for this is more than 36 months. The period for this is more than 36 months. And now, when we are talking about medium to long term loan, the main purpose is for minor irrigation facilities, farm and land development, farm mechanization, plantation, horticulture, allied activities, dairy farming, sheep, goat rearing, piggery and rabbit farming, poultry farming, fisheries, sericulture, beekeeping, mushroom cultivation, biogas plants, etc. So these are medium to long term loans. There is a short term loan, there is medium to long term loan. The main thing is you have to take care of the loan repayment time period. If the loan is repayment up to 18 months, then it is known as short term loan. When the loan is repayable for a period of more than 36 months, then it is considered as medium to long term, right? Now, what is crop loan? Purpose of crop loan is to facilitate the agriculturist undertaking farming, right? So the main purpose of the crop loan is to what? To facilitate the agriculturist who are undertaking the farming. It is actually for meeting the expenses for raising the seasonal crop, which includes the crop of seeds, which include the fertilizers, which include pesticide, irrigation charges, labor charges, agriculturist, etc. So these are all considered under crop loan. These are all done under the crop loan. So there is a short term loan which is repayable to 18 months. There is medium to long term loan which is more than 36 months. There is crop loan. Crop loan, which is actually for what? Which is actually for the undertaking farming activities, right? Now, next, there is a Kisan credit card. When we are talking about the Kisan credit card, the Kisan credit card is actually for the issuing of credit card. Okay, it includes the electronic card also. to farmers, and it is as per their land holding. So whatever their land holding is, as per their land holding, the Kisan credit card is issued to farmers, right? And it is for what? It is for purchasing of inputs, investments for allied and non-farm activities, right? Now the main objective of issuing the Kisan credit card is to provide a timely and educate credit support from the banking system to a single window farmer. So, when the farmer is there for providing educate and timely credit support, okay, from the banking system under a single window to the farmer for their cultivations and other need like for post harvest expenses, for consumption requirement, for farmer household, for maintenance of farm asset, for activities and allied to agriculture. These are all the purpose which are covered under the Kisan credit card scheme, right? Now the Kisan credit card, this is available for a period of 3 years, which is subject to the annual review. Now when we are talking about the farmers, so farmers are basically divided into two categories. Okay, so the first category is when the farmers, if they have the land holding of up to 1 hectare, then they are considered as the marginal farmer. If they have the land holding of up to 1 hectare, then they are the marginal farmers. And if they have the land holding of more than 1 hectare and 2 hectare, they are characterized as the small farmers, right? Next. Now, there is a word which is known as farm mechanization. Okay, now what is this farm mechanization? Farm mechanization, beside tractors, also include the use of other machinery, like there is a use of power tiller, threshers, combine harvesters, sprayers, dusters, power tillers, etc., for increasing production and improving productivity. So, farm mechanization is for what? Farm mechanizations is actually the using of different machinery for the improvement or for the increase in the production and productivity, right? So farm mechanizations include what? Farm mechanizations includes power tiller, threshers, combine harvesters, sprayers, dusters, power tillers for increasing productivity and production in the farm, right? Now the farmer should have the 5 acre of perennially irrigated land available for the use of tractor. So it is very important that if you want to use tractor for increasing the production and productivity of your farm, you should have a minimum 5 acres of land. You should have a minimum of how much? 5 acres of land. Okay. Now, next important thing is it should be perennially irrigated land, means it should have a irrigation system. That land should not be barren or should not be kept in the idle position for a long period of time. That should be perennially irrigated land. Okay. Irrigation should be there from a very long time in that land. So you should have a 5 acre perennially irrigated land, right? Bank also finance under farm mechanization. Bank also finance second-hand tractors or repairs of the machinery, which is financed by the bank earlier. Now the repayment period, if we talk about the repayment time period, it is from 3 to 9 years, depending on the borrower's activity, right? Now if we talk about the small and marginal farmers, so small farmers which have the holdings of 1 to 2 hectare and marginal farmers which have the holding of 1 hectare, they are encouraged that they should purchase power tiller on the basis of their land holding instead of tractor. In the farm mechanization, the main focus is there that you should use tractors. You should use more of tractors. You should use more of power tillers based on your land holding instead of only tractors, right? So farm mechanization, it includes everything: power tiller, thresher, combine harvesters, sprayers, dusters, power tillers, etc. You should have a minimum of 5 acres of perennially irrigated land. Banks should also finance the second-hand tractor. The repayment time period varied from 3 to 9 years. And the small and marginal farmers, if we talk about the small and marginal farmer, they should be encouraged to purchase the power tillers on the basis of their land holding instead of the tractors, right? Next and the last thing is minimum support price. Now, minimum support price is a scheme of the government of India under which the agriculture produces are purchased from the farmers at the declared MSP. So MSP is the minimum prices that is given to a particular crop if the crop price falls below the market price or below the price at which the farmers are unable to recover their production cost. Minimum support price is there for supporting the farmers from any losses, right? And for Food Corporation of India is the nodal agency for the minimum support price. Now, minimum support prices, so the government has announced the MSP for 25 crops currently, and this include Rabi and Kharif crop both, right? Now, there is a National Agriculture Cooperative Marketing Federation of India, which is the nodal procurement agency for oilseed pulses apart from Cotton Corporation of India, right? So this is the minimum support price scheme. Okay. Last is there is a Pradhan Mantri Jan Dhan Yojana, or it's not Pradhan Mantri Jan Dhan Yojana. It is Pradhan Mantri Fasal Bima Yojana. In 2016, the Pradhan Mantri Fasal Bima Yojana replaced all the other insurance schemes which are related to the to the agriculture sector. It covered two basic things. So there is a basic cover and there is an add-on coverage. Basic cover, if you have enrolled in the Pradhan Mantri Fasal Bima Yojana, so basic cover, it is mandatory, it is given to everyone, and it covers the loss from sowing to harvesting, right? Now, add-on coverage, this is additional optional. You can pay and have the add-on coverage. Now, add-on coverage helps in preventing sowing, adverse condition, post-harvest loss, and specific risk. Now, what are the exclusion? If there is a loss that arises out of war or nuclear risk, or any malicious damage or preventable risk, then these are exclusion from Pradhan Mantri Fasal Bima Yojana. Aadhaar requirement is mandatory for having the crop insurance. Clear? So this is the important thing related to this chapter. So let's start discussing some practice question. First of all, there is a Kisan credit card which are issued to the farmer. First of all, to withdraw money from the ATM, to purchase farm equipment, to purchase agricultural implement on credit from dealer, meet cultivation needs, non-farm requirements including the purchase of input, short-term requirements, working capital requirement for allied activities. So the correct answer for this question is what, everyone? The correct answer for this question is what? Kisan credit card is issued to the farmer for which of the following purpose? Kisan credit card is issued to the farmer for which of the following purpose? Everyone please answer this question. So if we talk about the Kisan credit card, it is issued to the farmer for this. D is the correct answer. To meet their cultivation need, non-farm requirements, including the purchase of inputs and other short-term requirements, working capital requirements, and the allied activities. Clear? Done? Okay, next. Under farm mechanization scheme, loan is given for providing irrigation facilities, cultivation expenses, purchase of farm equipment, or for digging wells. Everyone, please answer this question. Guys, just please answer this question. Everyone. Okay. So under farm mechanization, loans is given for purchase of farm equipments, right? So we were discussing about the NBFCs, non-banking financial companies. So I was telling you that the main difference between an NBFC, non-banking financial company, and a commercial bank is that the main function of the commercial bank is to accept demand deposit from the public for the purpose of lending and investment, right? But if we talk about the NBFCs, the main purpose of non-banking financial company is actually giving loans and advances and shares and stocks and debentures and everything. They are not in the process of accepting demand deposit from the public, right? Now if we talk about the microfinance and NBFC, so for especially giving microfinance loan, there is NBFC NFI, which is regulated by Reserve Bank of India. Now, what is microfinance? Microfinance means when the services, banking services is given to those individuals who have an annual average income of less than or equal to rupees 3 lakh. So if you are belong or if you belongs to the low income category group, so for that individual, for all those individual, okay, microfinance and non-banking financial companies, MFI, NBFC MFI is actually giving loans to microfinance institution, right? Now, if we talk about the next thing, NBFCs which are registered with Reserve Bank of India. So there are different type of NBFCs which are registered with Reserve Bank of India. Bank may extend working capital facilities as well as term loan facilities to all those NBFCs which are registered with RBI. So working capital facilities, term loan facilities, these all facilities are given to all those NBFCs which are registered with the Reserve Bank of India, right? All NBFCs, including the microfinance companies, they are required to register with the Reserve Bank of India, except for the few exemptions. There are few categories of NBFCs which are exempted from the registration of Reserve Bank of India. So there are different NBFCs which are registered with RBI, like there is NBFC, MFI, MFCs. These are all registered with the Reserve Bank of India. But there are certain class, there are certain companies which are exempted from the registration of Reserve Bank of India. Which are what? Which are exempted from the registration of Reserve Bank of India. Now, what are these NBFCs? Like there are microfinance companies which are subject to certain conditions. These are exempted from the registration of Reserve Bank of India. There are ARC, assets reconstruction companies. There are Nidhi companies, mutual benefit companies, chit fund companies, merchant banking companies. So these are all those companies which are exempted from the registration of Reserve Bank of India. Clear? Now, activities not eligible for bank credit. Now there are different type of activities, okay, of NBFCs to which bank finance is not available. There are different type of activities, like there is a bill discounted, rediscounted by NBFCs, investments of non-banking financial companies, current and long-term nature, unsecured loan, inter-corporate deposit, all type of loans and advances by NBFCs to their subsidiaries, finance to NBFCs for further lending to individual, for subscribing to initial public offering, and for purchase of shares from secondary market. These are all those credit, and these are all those activities which are not eligible for the bank credit. So if the NBFCs are discounting the bill or rediscounting the bill, for this bank finance is not available, right? Investment, if the NBFCs want to invest, okay, in any type of company by the way of shares and debentures, for these the discounts are, or the bank finance are not available. If there is an unsecured loan, for this the bank finance is not available. All type of loan and advances by NBFCs, bank finance are not available, right? Now next, prudential ceiling for the exposure of bank to NBFCs. So there are prudential ceilings for the exposure of bank to NBFCs. So first of all, the exposure to single NBFCs, which include the gold company. So maximum of 20% of bank tier 1 capital. So if there is a single NBFCs, but these exclude the gold company, right? So for this, maximum 20% of banks tier capital can be invested in these type of NBFCs. Now, if there is a connected NBFCs, so if there are the group of non-banking financial companies, so if a bank want to invest in a group of NBFCs, maximum of 25% of bank with tier 1 capital can be invested in these type of NBFCs. If there is an exposure to NBFCs predominantly lending against the collateral of gold jewelry. Now there is an NBFCs which are especially engaged in the gold jewelry business. Now for this, For this, maximum 7.5% of the bank tier 1 capital plus tier 2 capital can be invested, and the ceiling is 12.5% of the exposure. Aggregate exposure to NBFCs, the bank can fix their internal limit for their aggregate exposure if all the NBFCs are put together. Okay, if aggregate exposures to all NBFCs, which include the gold loan to the extent of 50% or more to their financial asset. So banks should have that internal sub-limits on the aggregate exposure of all such NBFCs. So these are all bank finance to NBFCs, right? Now, there is an NBFC MFI, non-banking financial company, which are especially in the microfinance lending, right? So NBFC MFI, first of all, it is a non-deposit taking NBFC. It is what? It is a non-deposit taking NBFCs. Okay, and it is registered under Section 25 of Companies Act 1956. Now, they have to follow and fulfill these two conditions. They have to fulfill these two conditions. First of all, their minimum net owned fund should be minimum of rupees 5 crore. And if they are registered in the northeastern region, their minimum net owned fund should be 2 crore. So for rest of India, minimum is 5 crore, right? But if they are especially in the northeastern region, the minimum is rupees 2 crore. Qualifying asset share. So qualifying asset means if there is NBFC who want to be classified as non-banking financial company, microfinance institution, for all those NBFC, there is a special condition that whatever your total deposit is, okay, you should not lend less than 75% of your total deposit as a MFI or microfinance lending. Right? It means that you have to lend. If you want to register yourself as NBFC MFI, you have to lend more than or equal to 75% of your total deposit as a microfinance credit. Clear? And if you are an NBFC, normal NBFC, not NBFC MFI, then for you there is a limit that you cannot lend more than 25% of your total asset as the microfinance institution. It is 25% currently, right? So for normal NBFCs, you cannot lend more than 25% of your total credit in the microfinance thing. But for those who is what? For those who are especially classified as NBFC MFI, for you there is the special circumstances that you cannot lend less than 75% of your total SB. We are going to discuss about micro, small and medium enterprises in India. See, this is MSME. This chapter is common in IEIFS as well as in PPB. So in IEIFS module A, you will get this chapter MSME, and in PPB we are discussing this chapter in module B, right? So let's discuss and let's start discussing about this micro, small and medium enterprises. First of all, there is a revised definition that has been given for micro, small, and medium enterprises recently. Okay, so in July 2006, Micro, Small, and Medium Enterprises 2006 MSMED Act 2006 has been notified. And from this, enterprise, the word enterprise actually replaced the word industry. So there is micro, small, and medium industry. This word has been used before 2006, but now there is micro, small, and medium enterprises. This word has been used. Enterprises actually replace the word industry. Okay, now when we are talking about the classification of enterprises, so there is micro, there is a small, and there is a medium enterprises. Now you have to study this in very detail. Very important these definitions are for all of you. When we are talking about the classification of enterprises, there is a micro enterprise. Micro enterprise are those enterprise in which the investment in plant and machinery does not exceed 1 crore. Okay, so the equipments in the plant and machinery should be less than 1 crore, and the turnover shouldn't be more than 5 crore. The turnover shouldn't be exceeding 5 crore. Then it is known as what? Then it is known as the micro enterprises, right? So micro enterprises, first of all, the investment in the plant and machinery or the equipments does not exceed 1 crore and the turnover does not exceed 5 crore, then it is known as micro enterprises, right? Small enterprises. Small enterprises where investment is not more than 10 crore. The investment in the plant and machinery shouldn't be more than 1 crore. Okay, 10 crore. And the turnover doesn't exceed 50 crore. It is a small enterprises, right? And medium enterprises, it means where the investment in the plant and machinery doesn't exceed 50 crore. Investment investment in the plant and machinery doesn't exceed 50 crore and the turnover doesn't exceed 200 crore, then it is known as medium enterprises, right? So micro enterprises 1 crore and 5 crore. Okay, small enterprises, the investment doesn't exceed 10 crore and the turnover doesn't exceed 50 crore, right? And for the medium enterprises, the investment doesn't exceed 50 crore, whereas the turnover doesn't exceed 200, right? And when you are going for the small, medium, and micro enterprises, then you should have a registration certificate and you have to register online from what? Udyam Registration Center. You have to do what? You have to register yourself in the Udyam Registration Certificate. Clear? Next. Composite criteria of investment and turnover for classification. So composite criteria, now this is very important to understand. First of all, there is a thing, if an enterprise is crossing the ceiling specified for its present category in either of the two category, investment or turnover, it will cease to exit the category and be placed in the next higher category. But no enterprises shall be placed in the lower category unless it go beyond the ceiling limit specified presently in both the category. This is very important. See, if you are a micro enterprises, example, right? If you are a micro enterprises, then if you have crossed the limit, for example, the micro enterprises says that the investment shouldn't be more than 1 crore, the turnover shouldn't be more than 5 crore, right? And you have exceed the turnover this year. Your turnover is, for example, 8 crore, right? Means you have exceed your turnover as a micro enterprises. So now you are ceased to become a micro enterprises and you are placed in the next category, that is small enterprises, because you have exceed any one of the limit, right? The investment turnover, and you have crossed that limit and so you cease to become a micro enterprises, you are shifted to a small enterprises. But if we talk about the degradation, this is all about upgradation. But for example, if you are a small enterprises and your ceiling is defined that your investment shouldn't be more than 10 crore and your turnover shouldn't be more than 50 crore. Okay, now you have downgraded, you are a small enterprises but you haven't achieved the limit for the turnover. Okay, and you haven't achieved the limit for the you can say for the investment also. Now in this particular year your investments is like, for example, your investment is less than 3 crore. For example, your investment is 3 crore, or you can say your investment is 90 lakh, and now your turnover also is less than 50 crore, or you can say to turnover just falls below 3 or 4 crore, right? Now you are downgraded to a micro enterprises. So for upgradation you have to pass any one of the limit. For upgradation you have to pass what? You have to pass any one of the limit. For what? For downgradation you have to not touch both the limit. When you are not touching both the limit for any of the particular year, then you are only downgraded to a smaller portion. Clear? Now, all units, whether it is a micro, small, or medium enterprises, they should have a GST, Goods and Service Tax Indication Number, and they have a listed PAN, and this should be treated collectively as one enterprises. So, when you are A, B, C, or D, or F, right, you are five these enterprises, but you five of the or for the calculation of this thing, right? So, if we talk about the GST, Goods and Service Tax Indication Number, if you have a GSTIN, and if you have a PAN, okay? So the same GSTIN, if this is for 10 units, the 10 units are treated as one unit. And if there is a PAN for 10 units, same PAN for 10 units, then all the 10 units are treated as the one unit. This is the composite criteria for the investment and turnover for classification. Clear? Now, how you calculate the investment in plant and machinery or in equipment? So, if you talk about that, yes, the classification, how you calculate the investment in the plant and machinery. First of all, you have to present your ITR, income tax return for the previous year, the basic thing. So, whatever your income tax return is there for the previous year, you have to present that for calculation. Second, for new enterprises, if there is a new enterprises, you are registering yourself as a new enterprises, then self declaration is acting as a proof for your what? For your calculation of plant and machinery. Now, if we talk about the turnover for turnover calculation, first thing very important, exporter of goods and service or export of goods and services or both, it should be excluded from calculating the turnover. So the turnover is calculated domestically only. So whatever you are exporting, either goods or services, these are actually excluded from calculating the turnover. You cannot include the export turnover in calculation for this micro, small, and medium enterprises. So remember. Second, turnover and export turnover, this should be linked with the Income Tax Act or CGST or GSTIN. And after 31st March 2021, you have your PAN and GSTIN, which are mandatory for a micro, small, and medium enterprises. Clear? Now, next thing. If we talk about the policies package for MSME, how the MSME are getting credit and finances from the bank and financial institution. First of all, micro, small, and medium enterprises, they are a part of priority sector, and lending to this sector is a priority sector lending. So obviously, if there is any credit that is given to micro, small, and medium enterprises, they are acting as a priority sector lending. And for priority sector lending, there is a target that has been given to the commercial bank and different financial institution, that you have to lend at least 7.5% of, say, ANBC means adjusted net bank credit, or CEOBE means credit equivalent off balance sheet exposure, whichever is higher, and you have to lend this to the micro enterprises, right? And you have to do what? There are some task that has been given on the recommendation of Prime Minister to micro, small, and medium enterprises, and the task has been given to them. First of all, you should represent a 20% year on year growth in credit. Whatever the credit you are giving, a 20% year on year growth should be registered on the credit which is given to micro and small enterprises. Clear? Second, 10% annual growth should be there in the micro enterprises account. And third is 60% of total lending to micro, small enterprises should be. Now, CIDB, Small Industrial Development Bank of India, is the principal financial institution for promoting financing and development of micro, small, and medium enterprises. CIDB, you know that CIDB's headquarters is in Lucknow. Small Industrial Development Bank of India is the principal financial institution for promoting financing developing of the micro, small enterprises in India. Clear? Next, when we are talking about the measures that has been taken for the micro, small, and medium enterprises for the promotion, enhancement, and development of micro, small, and medium enterprises. So, what are the measures that has been taken for these? First of all, there is a separate ministry which is working for micro, small, and medium enterprises. Why? See, micro, small, and medium enterprises, this is the backbone of the economy. When we are promoting the micro, small, and medium enterprises, then only we are actually contributing to the development of the economy. This is very essential part for the development of economy, and that's why there is a proper separate ministry which regulates the functioning of micro, small, and medium enterprises, and the ministry is Ministry of Micro and Small Enterprises, which is set by the government of India, right? Now, for promotion and development of this MSME, there are different skill development programs that has been introduced, entrepreneurship development program that has been introduced, assistance for technological upgradation, market assistance, cluster development, infrastructure facilities developments. These are the different plans or different programs which has been set up for the promotion and development of micro, small, and medium enterprises. Credit facilities. Now, credit facilities, yes, for the timely and adequate credit support of micro, small, and medium enterprises, there is credit guarantee for micro and small enterprises. There is a credit guarantee scheme for micro and small enterprises, which is CGTSME scheme, which gives confidence to the lender. And TREDS is a platform for financing and discounting of bill of exchange or trade receivables through multiple financiers. Third, for procurement, there is the public procurement policy for micro and small enterprises, and each central ministry, department, and public sector units have a target that you should procure at least 25% of your product from the micro and small enterprises. So these are all the measures that has been taken for the promotion and for the development of micro, small, and medium enterprises. Clear? Now, delayed payment. When MSME is a seller and as a buyer, you are delaying payment for the micro, small, and medium enterprises. So, as per the Micro, Small, Medium Enterprises Development Act 2016, payment which is in the respect of micro and small unit should be received on or before, subject to a maximum of 45 days of delivery. So, if you are a micro or small enterprises, you have delivered some good to the buyer is bound to make payment within 45 days on or before 45 days from the delivery. And if there is a delayed payment, then on the delayed payment the buyer has to give a compound interest or to the seller, and this can be 3 times the bank rate which has been notified by the Reserve Bank of India, right? There is a micro, small, and medium enterprises Samadhan portal. So this portal is actually created by district DC of MSME, okay, where the micro and small enterprises can file their application online and their complaints about the delayed payment. So delayed payment is again one of the biggest issue in micro and small enterprises, especially in micro and small enterprises, not medium enterprises. So if you are a micro or a small enterprises, first of all, as a buyer, you have to make payment to the seller, which is a micro or small enterprises, and this should be within 45 days from the delivery of the good. Very important, just remember this. Clear? Now, next, if we talk about the TREDS is an electronic platform, and this is for financing, discounting of trade receivables of MSME. I just have told you TREDS in the previous session, right? That TREDS is an electronic platform where sellers are only the participators, means the micro, small, and medium enterprises can only participate as a seller in the TREDS, right? There are buyers, there are sellers, which are MSME, and there are participants, which are bank and financial institutions who are ready to give finance and credit to the seller basis on the basis of their invoices. And in TREDS, always remember the TREDS, the discounting is done without recourse. Without recourse, it means that if buyer defaults on payment to bank or financial institution, then they have to absorb all the losses by themselves. They cannot demand repayment or reimbursement from the sellers, right? This is trades. Now, performance and credit rating scheme. So, a performance and credit rating scheme for micro and small enterprises. This should be in consultation with the Indian Banking Association and rating agencies, right? So, you should have a proper credit rating scores schemes and a performance rating from the Indian Banking Institution and the recognized rating agencies. right? Now, next is the cluster-based approach. Cluster-based approach. What is a cluster-based approach? Everyone, just please just like and share the video to the maximum you can. And if you haven't subscribed this channel yet, it's a request, guys, that please subscribe this channel and press the bell notification icon. Everyone who is watching this video, it's a request that please subscribe this channel and press the bell notification icon. Everyone who is watching this video. Okay, so cluster. What is a cluster of MSME? Cluster of MSME is the concentration of the homogeneous MSME in spread over a area or village or a town or a city. Means, for example, there is an automobile part industry which is spread completely in Pune. So Pune is a cluster for automobile parts, right? So cluster means the homogeneous nature of micro, small, and medium enterprises which are concentrated in a particular area or which are concentrated in a particular village or area or town or surrounding, that is known as micro, small, and medium cluster. Micro, small, and medium enterprises cluster. The clusters, the essential characteristics of a clusters are, first of all, they are similar in the method of production, quality control, test agency, energy consumption, pollution control, everything, right? Second, there is a similar type of technology and marketing practices that has been used by these cluster. There is a similar channel for communication among the among the members. There is a common market and skill needs. There is a common challenges and the opportunities on this cluster faces. Cluster-based approach to lending is intended to provide a full-service approach to extending banking services to the recognized micro and small enterprises. See, when there is a cluster-based approach is very important to lending, which is actually when the bank identifies a cluster, it is easy for the bank to go and have an inspection of that cluster, the to take the idea of the production of that cluster and the basis of the judgment. So bank find it easy whether to accept or reject the particular proposal based on the cluster's nature and characteristics, right? And that's why the cluster financing nowadays is very popular in this micro, small, and medium enterprises, right? Now, some common guidelines and instruction for this. First of all the loan application must be acknowledged. Acknowledged means either just accepted or rejected, and there should be a running serial number for every loan application. Now, there is no collateral security that can be asked if the loan amount is up to 10 lakh, which is for the micro, small, and medium enterprises, right? Bank can decide the dispense with collateral if the loan is up to 25 lakh. Now, there is a Government of India scheme which is the Credit Link Capital Subsidy Scheme, and this is specially given for the technology upgradation of micro and small enterprises. Now, what are the terms and conditions? First of all, the loan amount is not more than 1 crore. The subsidy is 15%, which is provided to all unit in the micro, small, and medium enterprises. Micro and small enterprises, not medium. Basis of subsidy means whatever the purchase price of the plant and machinery is there. Fourth, implementing agency, it is SIDBI or NABARD. So these are the important features which are related to the credit link capacity scheme, and this CLSS scheme is especially for technology upgradation in the micro and small enterprises, not medium. Clear? So this is the chapter. I have just given you a short idea of the chapter, right? Now let's talk about the question. So this is the question. Just tell me which of the following statement about trades is correct. MSME can participate as seller, but buyers and financier are the third participant. Only large corporations can participate as a seller. Government departments are not eligible to the buyer. Trades is not intended to facilitate the financing of trade receivables. Which of the following statement is correct regarding trades? Which of the following statement is correct regarding the threats? Everyone. Which of the following statement is correct regarding the threats? Trade receivable electronic discounting system. Everyone, you can all answer this question. Which of the following statement is correct regarding the trades? So if we talk about the correct statement, the correct statement is A. Micro, small, and medium enterprises, they can participate as a seller where the buyers and financiers are the other participants.
So let's start discussing this topic, which is the government sponsored scheme, right? So when we are talking about this government sponsored scheme, first of all, the very first scheme is DNRLM. DNRLM is Deen Dayal Antyodaya Yojana, National Rural Livelihood Mission. DNRLM scheme, right? Now, if we talk about this scheme has replaced the Swam Jayanti Gram Swarozgar Yojana. Okay, so this scheme actually was earlier known as Swam Jayanti Gram Swarozgar Yojana scheme, and then it has been renamed as Deen Dayal Antyodaya National Livelihood Mission, which affects from 2016. So, what was the main objective behind introducing this scheme is actually to maintain and to increase the quality of the life of rural livelihoods, right? So, it is actually to the promote the rural livelihood, the better the poverty reduction. Okay, it actually helps in the poverty reduction for by establishing a strong institution, it access to the financial and livelihood services to enhance the financial inclusion for rural communities. So mainly it is focusing on what? Mainly it is focusing on the rural activities. Okay, so everyone, first of all, this mission is all about to increase the quality of the life of people who are living in the rural areas, right? Now, what are the key features of this day NRLM scheme? If we talk about the key features of this day NRLM scheme, first of all, universal social mobilization is here. Okay. Second, the participating identification of the poor. Then, promotion the institution of the poor. Then, strengthening the existing self-help groups and federations, and training, capacity building, and skill building. So, these are all the key feature of day NRLM scheme, right? So, when we are talking about the day NRLM schemes, these are the key feature: universal social mobilization, participatory identification of poor, promotion of institution of the poor, strengthening existing self-help groups and federation, training, capacity building, and skill building. Okay, now when we are talking about this, there are self-help groups which are formed under the National Rural Livelihood Mission, and revolving fund is given as a supporting fund to the self-help group as a corpus amount, right? Now, if we talk about the amount per self-help group, minimum of rupees 10,000 and maximum of rupees 15,000. This is the amount which is given under the self-help group. Now, what is the purpose of this revolving fund? First of all, it helps in strengthening the institutional and financial management capacity. It helps in building a good credit history within the, right? Now, when we are talking about the borrowers under the self-help group, an interest subvention or interest subsidy is given, which is actually to reduce the interest burden on the borrower. And an interest subsidy is given, and this by interest subsidy, you can just reduce the interest up to 7%, right? And here, women self-help group, the women participants of the self-help group, they can get a loan credit from these organization also, and this is maximum of rupees 3 lakh per self-help group. Now, what are the lending norms for this self-help group? First of all, you should have been existence for at least 6 months. So for the past 6 months, you should have a existence. For the past 6 months, you should have a existence, right? And you should participate in the Panch Sutras. You should be participating in what? In the Panch Sutras. Panch Sutras means 5 things you have to follow daily: regular meeting, regular saving, regular interloaning, timely repayment, and up to date your bank of accounts, right? You should be classified as per NABARD, National Bank for Agriculture and Rural Development norms. Your existing, if you are existing self-help group, but you have been not operational, okay, you have been defunct, so the defunct self-help group also become active for the last 3 months. Then, if you have all followed these conditions, you are eligible to borrow loans under this scheme. right? Now, the loan amount, there is a cash credit limit, which is a minimum of rupees 6 lakh that has been given for a period of 3 years. And they have a drawing power fix, means you cannot withdraw the complete 6 lakh amount as one go. You have a drawing limit. For example, in the first dose, you have a 6 time of your corpus amount. So whatever your corpus amount, principal amount is, you can withdraw to 6 times from your principal amount, or a minimum of rupees 1 lakh, whichever is higher. So either 1 lakh or 6 time of your corpus amount, whichever is higher, you can just withdraw. Second dose, 8 times of your existing corpus, or minimum of 2 lakh, whichever is higher, you can withdraw. In third dose, you can just withdraw minimum of rupees 6 lakh based on the micro credit plan. And fourth dose, you can withdraw over and above 6 lakh based on micro credit plans which are prepared by the self-help group. So these are the what your drawing limits in first dose, second dose, third dose, and fourth dose. As you withdraw any of the amount, you have a repayment time period for the same also. Like if you are withdrawing in the first dose, you have a repayment time period for 24 to 36 months, which is monthly and quarterly installment. If you are withdrawing second dose, okay, so you have a repayment time period of 36 to 48 months, which can be withdrawn in monthly or quarterly installment. If you are in third year or you have withdrawn the third dose, you have a withdrawing time period of 48 to 60 months, and this is again in a monthly and quarterly installment. If you are in fourth year, you have a withdrawn period of 60 to 84 months, and this is withdrawal in monthly and quarterly installment. Clear? Now, if we talk about the securities and margin, yes, up to 10 lakh rupees loan or limit, there is no collateral and no margin that has been asked. Okay. But if the loan is above 10 lakh and above 20 lakh, then no collateral is required, but there can be margin that can be asked from the bank. Okay. Now, the next is the National Urban Livelihood Mission. So, for increasing the life quality of rural people, there is National Rural Livelihood Mission, right? But for increasing the life of or quality of the urban people, for providing them facilities, there is Deen Dayal Anodya Yojana, National Urban Livelihood Mission. Now, if we talk about this particular scheme, was earlier known as Swarna Jayanti Shehri Rozgar Yojana. Then it has been renamed as National Urban Livelihood Mission, which has been again renamed as Deen Dayal Anodya Yojana, National Urban Livelihood Mission. Right? Now, under this, there are different components like you will get a social mobilization and institution development, you will get a capacity building and training, employment through skills training and placement, self employment program, and support to the urban street vendors. So, these are the different components you are getting under this scheme. The main motive behind introducing this scheme is providing the financial assistance to individual groups. It provides supports to the self-help group of urban poor to access easy credit from the bank. Clear? Now, what are the proportions under this scheme? So, if we are talking about the promotions under this scheme, okay, so women beneficiary not less than 30%. Women beneficiary, there can be no less than 30%. SC and ST beneficiary, it should be at least at the same proportion in the city and town, right? Differentially abled beneficiaries, 5% with priority to women. And if we talk about the 15% of physical and financial targets earmarked for, right? When we are talking about this, the financial assistance is in the form of interest subsidy on bank loan, interest subsidy over and above 7% of the rate of interest, right? So these are the Deen Anodya Yojana National Urban Livelihood Mission, right? Now let's talk about the Pradhan Mantri Suraksha Bima Yojana. Now, Pradhan Mantri Suraksha Bima Yojana is the scheme is available. First of all, the age group for which this scheme is available. So the age group is 18 to 70 years. The age group is between 18 to 70 years. Okay, with a bank account who gave their consent to join an enable auto debit, right? So this scheme first of all is available for the people who are between the age group of 18 to 70 years. Aadhaar will be the primary KYC for the bank account. The risk coverage, if we talk about the risk coverage under this scheme, it is for accidental death, you will cover a risk of rupees 2 lakh, and for full disability and accident death, you have a coverage of rupees 2 lakh, and for 1 lakh for partial disability. When we are talking about the premium, rupees 20 per annum premium is deducted through order debit facility in one installment. And this scheme is offered by public sector general insurance company or any other insurance company. Clear? Now next is the mudra. First of all, the full form of mudra is micro unit development and refinance agency. Okay, Mudra is what? The micro unit development and refinance agency. So in April 2015, if we talk about the April 2015 micro unit development and refinance agency, it was set up and Pradhan Mantri Mudra Yojana was launched, right? The main objective behind setting this scheme is to provide financial support and lending to micro and small business entities, right? If we talk about Mudra, in Mudra there are three stages. Shishu, where it is covering a loan up to rupees 50,000. Kishore, where it is covering a loan from 50,000 to 5 lakh. And Tarun, where the loan is covered from 5 lakh to 20 lakh. Okay. Now, if we talk about the loan, is provided for income generated activities, not for personal use. And the refinance assistance is also there in Mudra Yojana, and it is available for a maximum of 36. Clear? Yes or no, everyone? Clear?
Self-help group, a very small chapter, very easy chapter. It's all about what is self-help groups and what are the characteristics of self-help group, how the self-help groups are formed, etc. Okay, so this is we are going to discuss in this today's chapter. So everyone who is watching this video, just please like and share the video to the maximum you can. And if you haven't subscribed this channel yet, it's a request guys that please subscribe this channel and press the bell notification icon. Okay, so let's start discussing this topic. First of all, what is self-help group? Self-help group is a voluntary association of the poor. First of all, what is self-help group? It is a voluntary association of the poor formed with the common goal of social and economic empowerment. Self-help group is a silent revolutionary concept that has taken place in the credit delivery system. Self-help group is what? This is actually a voluntary association of some people which have the same economical and social background, right? And they group together, they form a voluntary association, and then they starts saving some of the amount from each member side, right? And then the fund is collected, and then this fund is lended to one of the member who is in need. Okay, then these are known as the self-help group. The characteristic of the self-help groups are the member are the owner of that group, right? Secondly, the members are of same and social and economical background, right? Third, it is for the upliftment of the particular member or the members of the self-help group. They just try to save a particular amount, okay, and then just collect a fund, and then this fund is lended to the individual, and then this fund is lended to the individual. So these are the self-help group, right? Now, if we talk about the microfinance through self-help groups offers best form of credit for the unreached people and underreached people. It is for the unreached people and the underreached people. Clear? So If we talk about the self-help group, microfinance, I have told you, providing credit facilities and the banking services to all those families which have an annual average income of less than 3 lakhs per year, then it is known as microfinance. And when we are talking about the microfinance, the best way of delivering the microfinance is in the form of the self-help groups. Okay. So next, if we talk about the self-help group, what are the need of self-help group? If we talk about the need of self-help group first, it actually mobilize resources for individual members for collective development. Okay, so it helps in the collective development. So each and every individuals are joining hand, they are contributing some money to by themselves and form a fund, right? And then this fund has been utilized, right? These funds has been utilized for the upliftment of the member of the self-help group. So it helps in what? It helps in the collective development, right? Uplifting living conditions of poor. Okay, so it is what? Uplifting the living conditions of the poor. It create a saving habits. It actually mobilize individual skills for the group interest. It assists members financially at the time of need. It assists member financially at the time of need. It help in entrepreneurship development, identify problems, analyze and find solution in the group, organize training for the skill development. So these are the needs for the self-help groups. Clear? Now, if we talk about the self-help group, forming self-help group. First of all, the characteristic, how you are forming this self-help group. The very first thing is the number of members. So normally, if we talk about the self-help group, normally in a self-help group, there are how many members? So normally in a self-help group, we can see there are 10 to 20 members in a self-help group. Now, if the member exceeds 20 in a self-help group, then the registration become compulsory. If they doesn't exceed 20, the normal members are between 10 to 20%, right? And if we talk about in some difficult areas like some hilly areas or deserts areas, it is just 5 members in the self-help groups, right? Now, family income criteria. Generally, all the members should fall below the poverty line. This is the criteria that BPL, all person which are below the BPL, below the poverty lines, they are included to form self-help group, right? But if necessary, or in some exception cases, max 20%, or in some very exceptional cases, up to 30% only is allowed from those families which are marginally above the poverty line, not from the very rich class. Okay, so generally they are below the poverty lines, right? But if, for example, in some cases there is a need that, okay, we have to include some people which are above the poverty line, right? So we max to max 30% people are allowed, that too from marginally above the poverty line, right? Now, subsidy eligibility. So only those members who falls strictly below the poverty lines are eligible for the subsidies, not those who are above the marginally above the poverty line. Management of the group, if we talk about the self-help groups, management should not entirely in the hand of APL families. Okay, so APL members should not be the office bearers. Majorly, the self-help group is for the upliftment of those who are below the poverty line. So below the poverty line members should participate in the management decision. They help in the decision making. The decisions are not entirely in the hand of APL families. Clear? So these are the management of group. Next, if we talk about the restrictions on memberships, self-help groups should not have more than one member from the same family. It should not have more than one member from the same family. A person not be a member of more than one group, right? So if we talk about the self-help group, each family has only one member, okay, that participate in the self-help. Now, the group should devise the group management norms to bind itself. Building corpus, corpus means the principal amount. What is corpus? Corpus means the principal amount, right? So it should build up corpus amount through regular savings contributed by the members. So whoever are the member of the self-help group, they just regularly save and build a corpus amount which is lent to the member as a loan in the case of need. Loan to members means corpus amount should be used to give advance loans to the member. Now, bank account. To have a group's bank account, preferably in the service area bank branch. So, yes, bank account, yes, each group should have a bank account that should be in the service area bank branch. It should be that preferred to be in service area bank branch. Record. For a self-help group, it is very important that you have to maintain all the basic record, like you have to maintain the minute book, attendance register, loan ledger, general ledger, cash book, bank passbook, individual members passbook, etc. So these are all the records that you have to maintain in the self-help groups, right? So these are the self-help group. First of all, normally it should have a 20 to 20 members. Family income criteria means the member should lie below the poverty line. In some exceptional cases, max to max 30% is allowed from those families which are marginally above the poverty line. Subsidy eligibility, only the BPL members are eligible for subsidy. Management of the group, yes, it shouldn't entirely depend upon the APL families. Okay, so BPL families must participate in the management and be the office bearer. Restrictions on the member, self-help group should not have more than 1 members from the same family, right? Code of conduct, if we talk about the code of conduct, the group should devise the group management norms to bind itself. Building corpus, it should build corpus through regular saving contributed by the member. Loan to the members, corpus fund should be used as an advance loan to the member. Bank accounts should, each group should have a bank account which should preferred to be in service area bank branch. Records, yes, they should maintain a record like the minutes book, the loan ledgers, the general ledgers, the cash book, the bank passbook, everything. They should maintain a record. Clear? Now, self-help group and the bank linkage program. Okay, so first of all, opening the saving bank account. Self-help groups which are registered or unregistered and those who are engaged in promoting saving habits among their members, they are all eligible to open a saving bank account with the banks. Bank is offering not current account to self-help groups. Bank are offering the saving accounts to self-help group. Bank are offering what? Bank are offering the saving accounts to the self-help group. So lending to self-help group. The self-help group may be sanctioned saving linked to loan by bank, and it is the saving to loan ratio that is 1:1 to 1:4. And for matured self-help group, this can be even more. Now the bank is doing what? For example, as a self-help group, you have 100 rupees as a saving, right? So bank is giving you a loan of 100 to 400, right? So if you have 100 rupees saving, bank can give you X maximum as 4. 1:4 ratio means as maximum as 400 rupees as a loan, as low as 100 rupees as a loan. But for some mature self-help group which are running from a very long time, this can be even more. This can be beyond 400 also. Interest rate, the bank can decide the interest rate as per the guidelines. Service and processing charges fees. So there is a no service, no inspection charges that is levied on the loan which is up to 25,000 per member. So if you have a loan up to 25,000 per member, so no service charge and no inspection charges are levied. Okay, in case of the eligible priority sectors loan, self-help groups and joint liability groups, right? Presence of defaulter in self-help group. If we talk about the presence of defaulter in self-help group, self-help group is not in default. Some members being defaulter should not detract from financing the whole self-help group. So its complete self-help group is not a defaulter. And one of the member is defaulter, the bank should not reject the loan or financing to self-help group just on the basis that it is what? Just on the basis that it is actually dependent upon that. Okay,